Take the, yeah.
Good morning.
Morning.
Ms. Bradford? Here. Mr. Gunning? Mr. Brezant?
Here.
Mr. Tang?
Here.
Ms. Erden?
Here.
Ms. Yamamoto?
Here.
For the Director of Finance, Ms. Miller? Here. For the State Treasurer, Mr. Rufino? Present. For the Superintendent of Public Instruction, Mr. Johnson? Controller Yi?
Here.
Chairperson Brezant, you have a quorum.
Thank you.
So I'm supposed to read a little statement before we get going. The CalSTRS board meetings are live web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first names and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. Since the May Teachers Retirement Board meeting, CalSTRS received 2 emails requesting divestment from Enbridge, 2 emails requesting divestment from fossil fuels, and more than 3,200 emails requesting divestment from East African crude oil pipeline. Back to you, Chair.
Thank you. The first item on the agenda is approval of the committee agenda. Any changes or suggestions to that? All in favor?
Aye.
Any opposed? It's adopted. We now go to the next item, which is the opportunity for public comment.
Okay, good morning, everyone. If we could get a 3-minute timer, please. Okay, our first speaker will be Tabitha.
Can we do something about the volume, please?
I'm a senior researcher with United Food and Commercial Workers International Union. We commend CalSTRS for being a leader in ESG investing. We're concerned that investment managers use ESG terms to win your business. Thank you. My name is Tabitha Neiman. I'm a senior researcher with United Food and Commercial Workers International Union. We commend CalSTRS for being a leader in ESG investing. We're concerned that investment managers use ESG terms to win your business and burnish their image, yet may not actually have enforced ESG principles in their portfolio companies. The first example of this is Cardenas Markets, a supermarket chain in California's Latino communities owned by KKR North America Fund 11, a CalSTRS investment. UFCW has been organizing Cardenas workers and asked to meet its CEO last fall. Instead, Cardenas ran an anti-union campaign. A company posting for employees earlier this year was clear. A union is a bad idea for Cardenas Markets. Now KKR is selling Cardenas to an Apollo fund, and workers' jobs and tenure are vulnerable. These workers risk their health and their lives to sell essential goods during the pandemic, positioning your fund and KKR to profit. These workers in your home state deserve job protection during the sale and a good wage and benefit standard like that set by Cardenas' unionized competitors. At the same time, KKR recently received positive press for sharing profits of the sale of CHI overhead doors with that company's employees. According to the Financial Times, workers received an average of $175,000 and, quote, cameras for a subsequent publicity blitz were rolling at CHI's rural Illinois plant when they were told of their windfalls. In Illinois, KKR portfolio company employees got windfalls. In California, they've gotten an anti-union campaign and no protection for their jobs. You're also invested in the fund that we believe will buy Cardenas, Apollo Fund 9. So we believe CalSTRS will pay carried interest and profits to KKR to sell Cardenas to Apollo and yet remain invested in it. We ask you not to commit to KKR's new ESG fund, KKR Global Impact 2, until KKR guarantees workers' jobs and their rights in the sale of Cardenas. We also ask you to urge Apollo to halt Cardenas' anti-union campaign and to guarantee workers their jobs and their right to organize, thereby addressing income disparity in California. The second example where KKR does not live up to ESG standards is Q Group, a CalSTRS investment through KKR Asian Fund 3. Q is a Chinese artificial intelligence company that collaborated in 2020 with an arm of the Chinese Ministry of Public Security, the organ overseeing China's vast surveillance system. Q promoted that it had jointly developed surveillance technology in 2020 with a government lab run by the First Research Institute of the Ministry of Public Security. First Research Institute works with Chinese entities that are sanctioned by the US government, including for facilitating human rights abuses. KKR and Q deny the collaboration, while the government lab confirmed it to The Wire China. We wrote to your CIO about these concerns last winter, and Q removed its web postings after publication of The Wire China story. In our opinion, Q is wholly incompatible with ESG principles and is an unsuitable investment for a public pension fund. We urge you not to commit to KKR Global Impact Fund 2 and to seek a resolution to these core ESG concerns from KKR and Apollo. Thank you.
Thank you for your comments. Our next speaker will be Anaya.
My name is Anaya Sayal, and I'm a high school student and a campaign coordinator for the Divest CalSTRS campaign of Youth versus Apocalypse. Some of you may believe that CalSTRS divesting from fossil fuel companies will be harmful to the teachers' pensions. If that was true, then why did the largest pension fund in all of Europe announce they're divesting for financial reasons and say that the engagement strategy doesn't work? This can also be shown by the fact that BlackRock, the largest asset manager on the planet, studied their diverse client base and concluded that portfolios that divested, I quote, experienced no negative financial impacts from divesting from fossil fuels. In fact, they found evidence of modest improvements in fund returns. 1,500 asset managers overseeing a combined $40 trillion are now committed to offloading holdings in oil and gas, which drag down performance and carry a tremendous risk of stranded assets. So my question is, if all of these organizations have divested and clearly would not do it if they would be harmed by this choice, what's stopping CalSTRS from doing the same? Our bill, SB 1173, was of the utmost importance to helping prevent our planet from being enclosed in this disaster. As many of you know, the bill died this year before the Assembly got the chance to even discuss it. For my colleagues and me, this hurt severely. We spent countless hours working with other organizations, peers, legislators, etc. on the bill. I'm sure at least a few of you have experienced the disappointment of watching something fail that you worked so hard on and that you know is essential. Regardless, it helped far more people know about your commitment to the fossil fuel industry and helped us grow our coalition, which will be successful in passing such a bill. I know many of you are probably thinking, what's the big deal? Why all of this for one bill? Here's why. We are rapidly spiraling downwards towards complete and utter destruction. The safety of the living beings on our planet are at a risk higher than ever before. Scientists everywhere have been doing everything they can to call attention to this, hoping you, the people in power, will use your power responsibly. You have been given an esteemed position, a chance to truly impact a community. Please don't wait until a bill has to make you stop supporting the destructive fossil fuel companies. Divestment has been proven time and time again as a powerful tool. Shareholder engagement has never gotten a company to change its core business model. While CalSTRS may have experienced past success engaging with other industries, the very business model of fossil fuel corporations is incompatible with a fossil-free future. These corporations have billions of dollars in assets which will lose all value once we can no longer burn fossil fuels. No engagement effort will change these facts. Think about people like me, years from now, who will be forced to clean up a mess we didn't want to be in the first place. We're desperately asking for your help to save the planet from this climate catastrophe. And if you're extremely against divestment and just will not budge, then please tell us another way to resolve this issue. But engagement just isn't the way out, and it's been proven not to work. Thank you.
Thank you for your comments. Our next speaker will be Magdalena.
I'm Magdalena. I am with Youth vs. Apocalypse and Oath Guardians. I'm 14 years old and have been coming since I was 10 years old, asking you to be on the right side of history and join us in the work for climate justice. I made each of you some art, and they will be passed out soon. Has a back and a front. Last month, I had the honor of spending time with people in the Yakama Nation in Washington State. A very special elder named Mrs. Lavina Wilkins introduced us to a deeper level of respect. In the Yakama language, the word for respect is tamakni, and Mrs. Lavina published its definition as to maintain harmony and cooperation with all people, including those who have differing opinions from your own. Show care and regard for preserving and protecting the cultural traditions, beliefs, and laws of Native people. You recognize the country, the earth, and the earth will recognize you. So what goes up comes back to you. As I stand up here and think back on my experiences at CalSTRS, I continue to see that there has not been much tamakni. Being continually brushed to the side has felt painful and inconsiderate. Most teachers and young people who find out about your investments in fossil fuels are disgusted and rightfully outraged. What do you want to do as a board member to bring more respect to this crisis? When I think of the kind of respect Mrs. Lavina would hope for us in this room, I see a fresh and sincere new chapter ready to be written. Even though it will be hard, I desperately need to know that we can write one of realness, eye-opening moments, listening, open and easy communication, and most of all, you CalSTRS members getting that this is in time in history that we are in is absolutely different from anything we have witnessed before. We have gone through crisis before and we are going through it now. I hope you see how we can figure this out. I hope you see that we need to figure this out so we can work together to keep the oil in the ground. Also, I learned from adults at Fossil Free California that CalSTRS has voted against a number of climate resolutions written by very respected groups of green activist shareholders. It would feel good if you put it on your next agenda to learn about the details and specifics of these resolutions and how come CalSTRS has been on the opposite side of them so far. One no vote is more than we can play with or afford right now. In conclusion, are you open to meetings where we can actually talk and figure this out, how we can have tamakni, and not just this frantic feeling of coming up here for only a short minute, trying to get out everything we want said with never getting answers. Thank you.
Our next speaker will be Raven.
Hi, can I take this off the stand? Yeah. Hi, my name is Raven. I'm 18 years old from Oakland, California. Nice to see you, board. I've never been here before. Thank you for letting us speak. I'm obviously here to talk about fossil fuel divestment as well. I'm not going to address, the fact that divestment would, not harm workers' pensions. I'm not going to address the fact that the engagement strategy doesn't work because that's already been addressed, and there's a lot of information on that by people a lot smarter than I am. So I'm not going to talk about that. What I am going to talk about is, I'm sure you're all aware of the fact that we're in a time of incredible crisis, as has been described. And I'm sure that you all care about the climate as much as I do, or at least I'd like to hope so. When we walked in here, I think Chris Ammon said, I'm the villain, right? And he said it in kind of a joking tone. And I'd really like to think that that's not the case. Honestly, I don't think you guys are villains. I think you're just workers, doing your job. I'm really not trying to cry, because I really don't want to cry, but I just get a little bit sensitive. I think you're just workers doing your jobs, and I respect that, and I'm trying to do my job here too. But at this point, I don't understand how you rationalize not divesting from this industry. It's illogical as well as incredibly immoral. I guess, maybe you don't want to be here right now listening to us all kind of speak at you and maybe feel like we're judging you and criticizing you, And you may think that we just don't understand the real nitty gritty of pensions, and that, you would love to support climate justice. And there's a lot of other things you're doing, but you just can't, budge on this issue for whatever this and that reason. I've heard all those reasons. There are dozens of them. I've heard them all from politicians. We've heard them from members of the board. And we're just not satisfied with that. I don't think you can honestly tell me that any reason why you're not divesting is not just an excuse or a way to divert this issue, or just a straight up piece of misinformation. And so, I guess I just want to say, coming from us, we've been doing this work for a really long time. I've spent a lot of hours of my time in high school researching pensions and investment, which is something I didn't really want to do. I didn't really want to wake up at 4 a.m. and be in this board meeting. But there is no justification anymore for not divesting from fossil fuels. There is none. And whatever can be told at us, and whatever rebuttal is always given, because there is always one, it's just not cutting it anymore for us. So I just want you guys to know that. And I don't mean to sound like accusatory or angry, but it is kind of how I feel. Thank you so much for listening to me. And I really am hoping that we can have more conversations about this, not be placated, not be brushed aside, because we actually know a lot about this. We know a lot about this. Thank you.
Thank you for your comment. Our next speaker will be Ramari.
Hello, I'm Ramari. I'm a youth organizer with Youth vs. Apocalypse. Before I go on, I would just like to acknowledge the 2 new board members I see, Mr. Ken Tang and Michael Gunnings. Hopefully we can organize a meeting. I would love to talk to you too. And as new board members, I would just like to say a few things, share a couple facts with you. How does it make you feel knowing that air pollution from fossil fuel extraction costs the California economy more than $28 billion annually? These costs disproportionately fall on Black, Latin, and low-income Californians. How does it make you feel knowing that complete and public divestment would send a powerful message that CalSTRS will not be associated with an industry that threatens the lives and futures of their own members as well as the life on Earth? How does it make you feel knowing that treaties were violated to build pipelines on Native American land? How does it make you feel knowing that people across Eastern Africa are being forced out of their homes, their lands raped for their natural resources, their people massacred when they refuse to leave? How does it feel knowing that despite years of unsuccessful attempts to influence the fossil fuel industry, CalSTRS has failed to persuade these companies to reduce their greenhouse gas emissions, increase their renewable energy production, or reduce the fossil fuel financing by big banks? I would like for all of you to think on this, and especially the people of color here. Thank you.
Thank you for your comment. Our next speaker will be Katerina.
Hi, my name is Katerina. I'm not allowed to say how old I am, but I'm a kid, as you can tell. I'm going to try to keep myself together. I get very emotional talking about this. I have family in Ukraine that are hospitalized and can't leave the country. And just coming up here, not even thinking about them, it's just like, I don't know how to explain it. It feels like my heart is pounding, my limbs are shaking. It's like, I mean, I don't know how you're not supposed to get panic attacks when you're thinking about these things, because you're literally, like, we're put in a position right now that to me feels incredibly dehumanizing, because I have to prove to you in 180 seconds that my life matters. I mean, I don't know, have you ever had to be in that position, like to ask somebody else, like, can I have access to clean water and clean air? Can I have access to life? Like, I don't know if you've ever been in that position, but it's horrible. I don't know how, like, to explain to you the weight that puts on us as kids, because all we're asking for is for a future. And I'm sorry I get so emotional, but it's just like, I don't think you guys realize how hard this hits us because we're just kids and we just want to live our lives, but we can't because of this. Because when people invest in fossil fuels, they take away our access to clean water and clean air. And it's just like, I'm privileged enough to not live in a neighborhood where I have to experience those things. And I cannot imagine what it feels like to live in an area where your grandma has cancer, where everybody in your family has cancer, and you have asthma, because there are infrastructures disproportionately put in your neighborhoods, which are symptoms of white supremacy, literally attacking communities of color and working class people. I cannot imagine what kind of pain that brings someone. So I'm just asking you, like, if you don't care about me, if you don't care about any of us, at least think of your own children, because at the end of the day, I'm showing up for them too, because even if you guys like hate us at the end of the day, I love all human beings, and I just believe that everybody should have access to water and air and life. I don't care what your political party is. I don't care where you come from. We should all be able to find common ground in the fact that all human beings deserve access to clean air and clean water. These are fundamental human rights that are being taken away. And fossil fuels not only invest in these things being taken away, they invest in war, they invest in genocides from around the world. All these engagement strategies with an industry that is inherently exploitive. There's no way to cleanly burn fossil fuels. I don't know what they're telling you, but we have done the research. We have met with financial advisors. We know that there is no evidence supporting that your stocks will go down, that you will lose money from divesting from fossil fuels. We know that. We've met with these people. These studies, even from BlackRock, literally show this. The largest investor in fossil fuels in the entire world showed that if you pull your money out of fossil fuels and reinvest it into something else, you will not lose money. And I'm also standing here today for the young teachers because they deserve to have a pension when they retire. Because we know that the fossil fuels are a dying industry. The only reason why they're doing good right now is because my people are getting bombed and murdered and raped and genocide.
Our next speaker will be Raina.
Good morning. My name is Rena Myers-Dahlkamp. The tears may be fresh or different in this space, but I hope you let them penetrate deep because that's how real this is. I see some, only like maybe one of you not looking at and did not look at her when she spoke, and I pray that you'll look at me for this one. Thank you. In January, I provided public comment over the phone about the East Africa crude oil pipeline. Due to the escalating urgency, I'm rereading a portion today, and I also emailed you the full testimony via Ms. Diane Stanton, as well as an audio recording. I also attached in that email an article that was just sent to me this week by a Ugandan activist that I really, really encourage you to read. Local leaders who are speaking out against the companies building it, despite the threats of their safety, would like to speak with you. They've requested meetings to speak specifically with the two largest pension funds of the United States of America. And please contact me if you're open to meeting. My information is on what will be handed out to you today. And I offer this with faith. You will not detach from the responsibility and interconnection you have as investors of this pipeline and so many other similar projects, like also the war in Ukraine that Katerina just mentioned. Please know that the following descriptions do contain images of extreme violence. A friend in Eastern Congo began forwarding me videos of atrocities happening in his community. In areas where extractive companies you are invested in want access to land, people are experiencing mass displacement and massacre. When asked about the violence, one Ituri politician, Ituri is a region in Eastern Congo, and a businessman, he said, and I quote, "Our areas are full of oil deposits, and chasing out communities with violence is considerably easier than incurring the costs for relocating them to the areas for oil exploration, to other areas." And the first video I received was of a woman being hacked to death with a machete. The camera held very close, and then she was beheaded. Other videos have shown children and full families being killed in mass shootings and body parts being lined up and systematically filmed. The people committing these atrocities send the videos around to scare the remaining residents into leaving their homes and vacating the land. When I receive these videos, I know I have the privilege to choose whether I hit play or not. Witnessing someone's mother, father, partner, child, grandchild, sibling, or elder be murdered is something you can never forget. You can't unsee that. The images and the screams become part of your soul. Yet I must, because others are living it. They're feeling it, they're smelling it, they're running it while we sit here right now. Just while the same companies you're invested in continue business as usual. They continue accessing their roads, making their roads so they can keep getting to these sites. They don't even stop while this is happening around them. I please accept their respect to meet. Please reach out to me and tell me you'll have a Zoom call with these folks.
Thank you for your comment. Our next speaker will be Kevis. Our next speaker will be Kevis.
Hello, my name is Kara Stahlkamp, and I am a organizer with Youth versus Apocalypse. I'm also a member of the Contra Costa Interfaith Council, which supported SB 1173, which now is no longer, as you know. I've been coming here for years, and despite what you may think of us, you know, in the beginning, I felt hopeful, excited. Then I started to feel disillusioned, disappointed, angry. Now I just feel present. You know, and the fact is we all do things, all of us in this room do things that affect the climate, that negatively impact the climate. As Americans, those of us that are Americans, that is something we all do, and that is something that I own, and that is something we should all own. The fact is, though, as board members, you have an extraordinary amount of leverage to make an extraordinary choice in this generation. You know, also with the EPA ruling that just came, we are in trouble. And it hurts my heart to see these young people feel like they have to come here, because they do, month after month, year after year, to share with you what you know is right. I believe deep down you know is right. And I understand that you probably have a lot of people. I understand in my work as well, you have people that are telling you that you need to do a certain thing. And I know what that's like. But again, 2050 is simply too late. It just is. And I think we all know that. Many scientists say that we're already off the cliff as it is. And as Ramari and some of the others mentioned, these impacts are disproportionately affecting black and brown communities already now. And I don't know if you know this, but this is an opportunity for you. You don't even have to call it divestment, like the UC system, selling off the shares, whatever you want to call it. This documentarian here is making a feature-length film. He's been doing it for the last 4 years now on this very issue with CalSTRS. And I don't know if you know that, but this is an opportunity for you to do the powerful thing. And I just ask that of you. We'll keep coming back. We're not angry. We're all in this together. We're all impacting in different ways. Again, you have an extraordinary amount of leverage. Please use it. Thank you.
Thank you for your comment. That is the conclusion of our public comment for item 2.
Carefully, that this board shares your deep concern about the future of our planet, and we're doing as much as we possibly can to remedy this problem. You know, people can agree on the goal and maybe disagree or have differing views on how to reach it. Ours is a much more complex issue that requires a lot of find movements to reach that goal. And we spend a lot of time and money and energy in doing it. And I want you to know that we hear you, we care about you, and we're going to continue to listen to you, and we're going to try to solve the problem that you've addressed. I just want you to know that we're not ignoring you. We hear you. Thank you very much for coming. Appreciate it. Now, for the next item on the agenda, we have item number 3, the investment policy and management plan revision. Geraldine Jimenez.
Good morning. Geraldine Jimenez, Director of Investment Strategy and Risk. I think we still have to do that since I'm not on Zoom, right? Oh, there we go. So this is, in a way, a routine request to update our policy. I thought I would take a few minutes, though, since we have a few new board members, a little background on the asset liability management study. So in 2020, we finished it, and it is a study to determine how we can actually meet our liabilities over the long term, and it shows steps as we go through each asset class and we invest. And we never force ourselves to that step on the day one that we approve this asset liability management plan and asset allocation. So I'm pleased to say that we're well along the way. We're almost to the final step. We have inflation sensitive going up by 1%, real estate by 1%, and global equity down by 2%. To affect this, we're actually going to change the illiquidity maximum in the portfolio or in the policy. But I also want to give a little background on there because I think that might be concerning to some, but I want to give more color on how we manage our cash. We actually manage our cash very carefully, working with the finance team, working with our operations team. We know what benefit payments are due. We know what contributions are coming in. We model out if there's a big market sell-off, what cash do we need to rebalance? We also consider all private asset contributions and capital calls that would be coming in. And we spend a lot of time modeling this out. And then we go to our risk allocation committee at least twice a month with these estimates on cash needs. And then we have various sources we can use to actually rebalance. So I wanted to give you comfort, but by expanding this illiquidity number in the policy, we continue to manage our cash very effectively and every day, frankly. So rest assured that changing the policy is not going to affect how we change that. And we're in the next asset liability management study will be more explicit on how we manage liquidity in each asset class to even be clearer. As you know, the actuaries tell you we're a mature pension plan and we do have more benefit payments going out than we have cash coming in every month. It's just a fact, and it'll continue to expand. And so we'll be more aware and modeling more and more managing our liquidity. So I wanted to offer that assurance. And speaking of that asset liability management, it's going to start, and I gave you a timeline in your agenda. And I also let you know that we're going to update this policy. This policy, as we've discussed, is kind of 20 years old, and it's time to modernize it. We won't shock you with anything. In November, we're going to show you kind of a mapping of what we have and what we think the categories would look like in the future. And then we'll slowly bring you back kind of revisions so you can opine on that and then send us a way to update and address any questions or concerns you have. So that schedule's in there too. You'll be seeing a lot of us over the next year on these topics. So today, because this is more of a routine, I am asking, it's a first reading, but if it pleases the board, if you could approve it today, we would hope to make this effective July 1st, since we're actually already at these targets in the portfolio. So again, that would be real estate inflation sensitive up by 1%, global equity down by 2%, and the maximum illiquidity in the portfolio. And I'm happy to take any questions, comments you have at this time.
Before we have any questions from the board, would our consultant tune in on this and give us his views?
Mr. Chair, Alan Emkin, McKeed Investment Group, thank you, and nice to meet the new board members, and it's even nicer to be here in person after 2.5 years. It's very strange. I've been coming to these meetings for the new members for over 30 years, and the names have changed, but the sentiments haven't and the goals haven't, and it's a privilege to be here. So nice to meet you indirectly. We support the recommendation unequivocally. It's just important to keep in mind that a pension plan has many, many moving parts and it's dynamic, and there's constant change on both the asset side and liability side. And this is just part of the process of constantly updating it to meet the changing environment. And over the next year, you're going to go through a deep dive on asset liability management, and that is the lifeblood of a pension plan. It's really understanding how the pieces fit together, and this is just an important component of that and one step in the process. In our opinion, the staff has done an excellent job in providing you the information. Thank you, Mr. Chair.
Okay, the first question is from Blake Johnson. Blake.
Error on my part.
Oh, okay. Any questions?
Oh, you know, I think they didn't switch the microphone.
Oh,
I have
okay,
no
Betty.
question.
Betty, of course. I was surprised that it wasn't Betty. She always sets the table.
No. Thank you, Mr. Chair, and welcome to the new board members, and congratulations, Mr. Chair and Vice Chair Miller, on your leadership of this committee. Geraldine, thank you for the report. I think the allocation limits that you've described are reasonable, and I'm prepared to move it on this first reading. But could you provide maybe a little bit more color around the increases in the illiquid assets and kind of what and the other potential issues if market turmoil continues to be what it is, particularly with high inflation and persistent supply chain shortages? What can we expect?
A bigger question of why the illiquid assets, and during the study we discussed, and will be even more explicit next time, there is what one would call an illiquidity premium. We think they offer superior long-term returns, so we're doing that trade-off. But that being said, we need to manage the liquidity more carefully as we go into more illiquid assets, right? And so while we could sell public assets to fund these, that's not ideal. We actually need to be more timely and more thoughtful about how we keep our liquidity on hand and not keep too much liquidity, right? Because the more cash we hold, the less return we have. I'm not sure I addressed your question. I think you're just worried about if we go into a period of large market drawdowns. So I'll give you a little color on that. When we do have large market drawdowns, we can use derivatives to rebalance in. And so we actually won't need as much cash, right? We would only need the margin on hand. So we actively use these tactics to rebalance and make sure we have the exposure we need during these market stress moments.
Yeah, I'm happy to make a motion, Mr. Chair, to approve this. And obviously, we're at a point in time where a lot of issues kind of feeding into this, and so and I trust the staff will be monitoring that. But it is just a lot of uncertainty.
It's been moved and seconded. Karen Yamamoto, do you have any comments or questions?
Well, I just have a question because I addressed this earlier about illiquidity versus liquidity and what does that mean and how, because my understanding was liquidity means easy cash right away. Illiquidity means that it takes a little bit longer and a little bit more, I guess, research and doing that to pull that money out, correct? So when you say that we're going to raise that illiquidity amount to 50%, that means it's going to be that higher level that we have that illiquidity available. Is that available? Is that the right word? Okay.
Half of our portfolio can be in assets that are not daily traded. It's acknowledging that is true, that half of our portfolio won't be. But that being said, the other half can be daily traded.
Okay.
And so if we did need to raise liquidity, we could sell the part that is still liquid or use the other tools, credit lines, derivatives, as I mentioned. We have various tools if we need to raise liquidity. And there's quite a bit that goes into considering what you want to do, because sometimes selling your liquid securities can be very costly if you're selling at the wrong time. So we spend a lot of time thinking about what do we want, how do we want to raise liquidity if we need to?
Okay, so that's one part. Can I ask another
Sure.
part? Okay. The other part I wanted to ask was because we're taking from public global equities and giving it to the other real estate and inflation sensitive, how does that affect public equity, global public equity? How does that affect that portfolio?
So we've already done it, but basically it's selling down its position. So it's 2% less of actually we have allocated to equities.
Okay, so they, in essence, then they get less money to spend.
Yes, that's true.
Okay.
Mr. Ailman?
Just for Chris Ailman, Chief Investment Officer, for the sake of the new board members, and it's hard to turn, I think, the pages electronically, but we always have a fund liquidity report in the risk report, which is part of the CIO. So in this case, it's page 15 of attachment 1 on item 4. I know that doesn't help a lot, but it shows how many months of benefit payments we have in cash and others. And just to assure everybody, in our tier 1 liquid assets, we have 125 months, so 10 years of liquidity to pay benefits. So that's why we know it's, in our view, reasonable to go to 50-50 liquidity, illiquidity.
Thank you. Thank you, Mr. Chair.
Ms. Miller? Great. Any further questions? There's been a motion and a second. All in favor, say aye. Aye. We'll take a roll call, I forgot. Sorry, this is my maiden voice.
Ms. Bradford? Mr. Gunning? Mr. Brazat?
Yes.
Mr. Tang?
Yes.
Ms. Erden?
Yes.
Mr. Yamamoto? Miss. Sorry. Miss. It's my first live one, too, so. Miss Yamamoto, sorry.
Aye.
Miss Miller?
Aye.
Mr. Ruffino?
Yes.
Mr. Johnson?
Yes.
The motion passes.
Didn't get that. He called on me. The next item on the agenda is the business plan. Oh, wait a minute. No, sorry. Chief Investment Officer's report. Oh, I've got them.
You've got them.
Are you talking about the proxy material?
No.
Oh, okay.
But I will address that first. To set the record straight, because nobody in public comment mentioned, well, they did mention it, that we, in our proxy voting, we did vote against some shareholder resolutions pertaining to the environment. Only a handful, well, not a handful. We vote, let me say it this way, we vote 10,000 proxies. And, you know, they have, there were over 1,000 shareholder proposals, a huge amount, probably more than half related to climate, a record number in total. But you have proxy voting guidelines that you give staff, and then obviously even within that we have guidelines. We vote these by hand and electronically. So we really look at every single one. It's a judgment call in some cases, the shareholder resolutions, if we think they're too onerous and go beyond what we're asking companies to do, we will vote against them. And it's trying to show companies that we're being reasonable. We're pushing them, but we won't be unreasonable. Some of the highlight ones that we voted, notable votes on climate risks that we supported were Chevron had 3 climate proposals. Caterpillar, we voted against the entire board for failing to produce a TCFD report. In Shell, we chose not to report or to support one shareholder proposal, but have been pushing that company and others because they've already established targets for 1, 2, and 3, scope 3. And then on ExxonMobil, we supported both of the climate-related shareholder proposals. So we can give you details on that. This year, we also saw a lot of votes on racial audits. We supported the vast majority of those, particularly in IBM, HD, and then at Costco. And some of those proposals, I'm pleased to say, actually passed. Now, shareholder proposals are advisory to the company. They can't mandate company action, but we then hold the companies pretty accountable if they don't listen to the shareholders, and we'll vote against the rest of the board next year if they don't do something. Most of the companies tend to be, when it passes a 50% vote of shareholders, those boards pay attention, and most of them are then following through. So I just wanted to share that as far as the public comment. If you would allow me one opportunity for introduction, in July we have our summer interns, and I'm always very proud and excited to have them here. I always tease them at one of their hazing incidents is they have to come introduce themselves in front of the board. But we have 10 students this summer. Some are hybrid and not working in the building. Some are working remote. 5 of our students work directly for us through enterprise services at Sac State. The other 5 are with us in a joint effort with some of the affiliate groups. So if I can invite them to come up and grab a microphone, just if you would indulge me just a few minutes, they'll state their name, their school, their year in school, and any other questions if you want to ask them. Right.
Hello, my name is Safira. I am from California State University, Sacramento, and I just recently graduated. Thank you so much for having the honor to speak here.
What was your major?
Finance.
Oh, good.
Hi, my name is Jackson. I go to UC Davis. I'm going into my 3rd year, and I'm studying economics, and I recently also picked up a statistics major as well. Thank you.
He's our stats pro. Scoot over that way so they can, I don't want to be in camera. Thanks, Rachel.
Good morning. My name is Rachel Alfred. I'm a rising senior at the University of California, Berkeley, studying political economy. Nice to meet you all.
Where's my Berkeley? Cheers.
My name is Liz Croce, and I'm with the Girls Who Invest program, but I go to Bucknell University. I'm a rising junior, and I'm a biomedical engineer, which is definitely different amongst the group, but yeah.
And she flew here last night from New Jersey.
Yes.
Hello, so I'm Edgar Chavez. I'm a rising junior at UC Berkeley. I'm studying business administration at Haas. Go Bears.
Good morning. My name is Daniel Godinez Moctezuma. I just recently graduated with my degree in economics from Sac State. It's a pleasure to meet the boss's bosses.
Hello, my name is Amiali Ramirez. I attend UC Berkeley. I'm intended business administration and cognitive science, and I am coming from NAA, New American Alliance.
Cognitive science. You're learning a lot about people by watching us.
Hi, everyone. My name is Jyotika. I go to CSU East Bay. I'm completing my MBA in finance and business analytics, and I'll be done in December of this year.
Thank you.
Good morning. It's great seeing you all in person. I met some of you virtually already. But I'm Nick Sweet. I'm with Sacramento State, first year of their MBA program studying finance.
Thanks, Nick. Boy, so hats off to the team that puts this together, does the interviews. We always have a wonderful, diverse crowd, and it's fun to have them here. So thank you for taking the time on that. I passed out for you, hopefully everybody has on their desk, just a one-pager, and we have them available for the audience, for anybody that wants them. Just of the index returns, these are not our returns, the index returns of last year. Because it really was quite a unique year. As I say on there, it's the tale of 2 halves of the year. The first half of the year through December, the markets were up. We were up 8.5. But then obviously the second half of the year has been tumultuous and is technically a bear market. It's very subtle on that graph, but the lines on the first half of the year tend to be smoother day to day. Whereas you'll notice if you look closely that a lot more spikes in the second half of the year. That really does kind of show you the volatility, that we had many more days where the market was up or down 2% and a lot more volatility in the second half. And obviously that's continuing on. The total of our fiscal year, the U.S. equity market was down 14% in our index, but importantly, over 3 years, it's up 9.5%. Non-U.S., as June pointed out, most of that negative return is due to the currency, the fact that the U.S. dollar was so strong. Many foreign markets in their own currency were off and soft or broke even, but not as negative. When you page down the world market index in Bloomberg, boy, it's just red numbers after red numbers. There are only like 3 countries in the whole world that actually posted a positive U.S. dollar return. And over 3 years, the U.S. market is only up 1.7%. So being global hasn't helped in this time period. And we'll see, mostly due to the strong dollar. Next, I showed you fixed income. The return for the Bloomberg Aggregate Index was negative 10.3. It's negative 0.1, almost 0.9 over 3 years. And that's really the yield curve. The dotted line is where it was last June. The blue line is where the yield curve is now. You can see why we say it's so flat once you get past 2 years. And at times that has gone inverted. In other words, the short end has been over a 3% return and been slightly negative. Then the bottom chart is really just shows you our assets. We started the year at 308 a year ago. We did end the year, we think the final number will show we're over 300 billion still in total assets. I don't have our fiscal year return number yet. We won't have that for about a week. What I can tell you, it is negative. We have a negative cash flow, so we didn't drop the full 7 billion you see there. Part of that is paying out more in benefits than we get in contributions. But it's going to be a negative number, probably a very small negative number, somewhere around -1% to -2% would be my guess. And I think when we look at our peers, you're going to see most of them slightly negative. There may be a handful of peers that are positive, and that would only be due to timing of their private equity portfolio and the lag. You know, private equity generally is priced back at March 31, so it's before some of this big decline. I'm starting to hear from some peers that they're, almost as much as -5 to -10. But when you ever see peer returns, the first thing is going to be asset allocation. They will almost always explain it. This year will be a little unique in that the sub-asset weighting, whether people had a tilt to value stocks or growth stocks. Many of you might remember Kathy Wood and the ARK fund that was so popular last summer and then just gave away all of its gains. And the same with the NASDAQ. It went from a positive return last summer to a deep negative return by the time we got to June. So growth stocks will be hurt a lot. People with a value tilt, we have a bit of a value tilt. I'll give PERS credit. They should have a value tilt, as far as we know, should do better in this kind of a market. What you care about is the 3-year return. 1 year is like the pace of a mile in a marathon. And last year was below our pace. It's going to be a negative number. But the 3-year number is still ahead of our pace. It looks like that will be a positive 9% return for 3 years. So it will help the funding plan when you talk to the actuaries. That probably won't be until next spring, so it's a long time from now. But that's an important thing. Now, last year was so positive, it gave us such a nice lead, we could be flat another year and still have a 7% 3-year return. Knock on wood, hopefully we're not flat again. But obviously then 3 years from now, that year rolls off. So I do care about individual years, but again, it's that pace and that blend. So we'll watch that.
Chris, may I just ask one question?
Please.
Yeah. With respect to valuations in the private equity portfolio, historically, have we seen any significant difference between the final number and the number that we get at this stage at the end of our fiscal year?
Bill, yes, the answer is yes. They don't write those assets up and down as quickly as the public market moves. But we have seen as much as a $500 million value shift. Keep in mind that right now the private assets are being priced as we go up to March 31. If you bring them forward to June 30, obviously you would think they were down again. The market was down over 10% during that time period. the private equity assets won't drop as much, simply because it's an appraised value, so they drop slower. Real estate's a good example. Also, Mike DeRay likes to point out that when you go to sell a building, if the price is less than what you think, generally you just pull it off the market. So prices are sticky, and private assets are sticky when they decline. They don't trade as much. But we will probably see lower values when we get the June 30 numbers. We won't get those until about November, December of this year.
Time, but just to follow up, because I'm curious, because of so much private equity being traded among private equity sponsors, does this impact the parallel that you would make with real estate? Because it's really, you have buyers and sellers that are in the same position. I mean,
they're in the same. Yeah, no, I know what you mean. It's a unique exit strategy now to sell to another buyout fund. But that buyout fund is just as greedy as the one selling. So they want a low price where the other wants a high price. We've found that generally it's been on market pricing, but the prices for private equity are steep. And I would not say there's funny business, because the firm selling has different investors, and even though we tend to be in both partnerships, but most aren't, and they want to get their highest price. It's not our favorite thing, because there's a transaction fee and lawyers and costs that go with that handoff. We would rather see them sell to strategic partners or sell out in the public market. But that does cause that transaction to kind of come to a true market price. Alan, were you going to add something?
During periods of uncertainty and when the public markets aren't doing well, transactions slow down. And that's really, whether it's real estate or private equity, people don't want to part with their assets if they believe they can get a better price down the line. And so don't be surprised to see that stickiness be there, because there's an unwillingness to book the loss, and there's the optimism, and these people are generally very optimistic, which is justified by the fees they get paid. They should be optimistic. So I had to put that in, Mr. Chair. I apologize. I take that off the record.
No, we'll leave it on the record.
Yeah.
Hopefully our sponsors will.
But that's the natural human and business reaction to what happens during periods like we're going through.
Thank you. Please.
And just real quick, a couple of slides. No surprise to you, inflation's the highest it's been in the last 40 years. You can really see that sudden spike, and is staying persistent despite what Bernanke, Greenspan, I'm going to run through all the Fed chairmen. Anyway, the Federal Reserve said, this was back at June 30. Your book has the one as of, or this is back at June 17. Your book has the one at June 30. The only change is actually that curve came down a little bit, right, to 3% across the board. But a big shift up in the last year, as we expected. Risks on the horizon, if I go up to the crow's nest and look out, obviously inflation continues. We're seeing central bank tightening across the board. I would now cross off that letters BOJ, that's Bank of Japan. They announced today they are not going to tighten, and the yen is going to historic cheap values. So if you have any interest in traveling to Japan, currency's in your favor, like crazy right now. We have strong corporate balance sheets. We had a strong labor market, although today's unemployment claims weekly jumped for the first time. But really, it's a question of, as you know, how long will the Fed raise? How much will they raise? Will they keep doing it? We still think it's another 75 at the next meeting. Everyone is speculating about next fall and then into the winter, about how far they will go. The important thing in the minutes they said is they are willing to hurt economic growth, cause a recession in order to control inflation. You know, the Fed has two mandates: full employment, economic growth, or full employment and keep inflation down. They're willing to hurt employment, which is the economy, to keep inflation down. Long-term risks remain, obviously, Russia, Ukraine, The China-Taiwan tensions, I would highlight, there have been a lot of China flying over aircraft and doing all kinds of nasty stuff. I don't expect that to pop up this year, but they're not playing very nicely. And then obviously we put on there from now on the U.S. and global energy transition. As much as we would hope that to be a smooth and even thing, as the students said, we're very worried that that's going to be very lumpy, bumpy, and become it will surprise us when it happens, when oil goes up or goes down, and there are fights, but I think that's our future for the next 10, 20 years. With that, any other questions?
Ms. Miller.
The risk that that potentially has to the fund and how long we expect it to last, and any other lessons from the 70s, including between stagflation and energy, that we should be thinking through.
Well, credit the chair because he brought up the word stagflation. I think it was early last fall before anybody mentioned it. I still think it's a very legitimate risk because if the Fed wants to stop or slow the economy down, stagflation is high inflation and no economic growth. And as you said, Ms. Miller, last time was in the 1970s. There's almost no asset that does well in a stagflation environment. So it's just plain bad for everything we own. The one thing that's bright light in stagflation is it usually does not last long. Maybe 12 months to 18 months at worst case, but it's oftentimes just a 9-month period. I think the Fed is much more effective and willing to use their power now than they were in the 1970s. And they're trying to really avoid going into a deep recession, which would be stagflation. I just heard some economists today reading the minutes, really feeling that it'll be a technical recession. In other words, we'll have very slow growth, maybe GDP at 0.5%, which is technically still growth, and so technically not a recession. I always say it will feel like a recession. And maybe what, the telltale sign, I think, for us, anecdotally, will be all these help wanted signs will suddenly come down. And then we'll start hearing about layoffs. And you're hearing little snippets of layoffs in certain industries in unique cases. But you still see a lot of people looking for employees, and that needs to slow down. And that's what the Fed's going to do by just raising rates until they really cramp down on the economy. In our case, we have the inflation-protected or inflation-sensitive assets that do well in this time period. I'll be honest with you, I've always said it, 5-6% of the assets is not enough. Stocks do well at the beginning of an inflation cycle, and I think that's why we saw stocks so strong last fall. Now they're suffering as they do because prices are rising. The price of an entry good or a supply to a company is rising, and they cannot pass that on to consumers as much as they thought. We're about to hit second quarter earnings, and it will be interesting within those quarterly calls how CEOs describe their ability to pass on that inflation or not. I don't think it's there anymore, and I think we'll start to hear them say they're getting earnings squeezes. That's the kind of thing that is a sign of slowing the economy. The market may already be reflecting that. It may not, and if we have bad earnings or weaker earnings, then the market may be in a tougher place come later in July. It's something we and the staff are looking at and paying attention to. Our asset allocation, our house view is defensive, but we also know that stagflation will, hopefully this time, will not last long, and then we think there's opportunities on the other side of that.
Indicators of an economic downturn in terms of real estate and what we're seeing and with the rising rates and how we're feeling about.
Yeah, real estate's a really tough market because when you think about institutional real estate, no one can quite figure out the office market because office usage is just all over the map and down. Retail is certainly now, has already suffered from the Amazon effect, but now it's even worse because we all got used to it during the pandemic. Apartments are still in high demand, and you can see the construction. So there is a supply-demand question, and they think the demand is still huge. part of the question, I assume, is about single-family homes. Those are starting to slow and should continue to slow because a 1% rise in interest rates, a mortgage rate, is a big hit on a monthly mortgage, and that will slow a lot of people down. People are used to refinancing now, so I wouldn't be surprised if you still see buyers come into the market with the hope to refinancing. You still have a lot of all-cash buyers. People who had the baby boom had paid off their home, sold the big house, downsized, but you're getting to the end tail of that. And I know even personally on Zillow, I start to see price drops, not major, $10,000 or so, but people are not moving prices up at all. They're really flat to stagnant, and demand is slowing as people take a second look. So that market, there's huge demand, but it will slow because it becomes less affordable. And, another 3 quarters, another 3 quarters after that, mortgage rates are going to be up to 6-7% in no time.
Thank you very much. Karen Yamamoto.
Hi.
My partner.
Thanks. My question has nothing to do with that, but it's kind of your inevitable surprises when you talk about the digital cyber attacks. Can you talk a little bit more about what you mean by that?
Yeah, some of the groups that I'm part of, the Pacific Pension Institute, the 300 Club, have had speakers recently from the federal government on cyber attacks. And they emphasize that Russia, well, first it's China, then it's Russia, North Korea, Iran. Well, let me go down the list. China, Russia, Iran, North Korea, and Turkey have really institutionalized cyber threats. What I understand is that the U.S. is actually still superior, and so but they think that is still a risk. I can't remember the names of some of the famous cyber attacks we've had where there's, the loss of service is one thing, but where somebody embeds in a software program a code, SolarWinds, thank you. And they embed it in a program and it gets spread around by other people and then they activate it. That's still a legitimate threat. They think the U.S. does a good job of blocking it. Think of how much we personally do over the internet, and I look at how much we do internal over the internet, and it's rather staggering. We spend a lot of time, as you know, with Brian, on our own internal cyber risk. We demand most of our business partners, especially our custodian bank, to be absolutely cutting edge on cyber risk and cyber technology. It is inevitable that we have another threat and another problem. I just don't know when and where. They're pretty confident that, as they say, you don't hear about the victories where we stopped something. You will only hear about the ones that get through, and they know that they can't stop everything.
Right, because a lot of our information is tied to the school districts, our employers as well. So sometimes we see those attacks or interventions, or I don't know what they call them, incidents. So that's how it will affect all of us, right, if there is an attack. And so that's why you're saying inevitable surprises, that it could happen. We just don't know when, but we have the knowledge and the support that we need at CalSTRS to circumvent all of that?
I'm probably going to regret that this popped into my head, but my analogy would be an earthquake in California. We absolutely know we will have an earthquake. We don't know whether it's a 3 or a 7 or a 9. And that's the same thing with cyber, is it happens every day, but most of them are small and we never see them or feel them. Every once in a while, you'll have a SolarWinds that might have been a magnitude 7 earthquake. And so it is absolutely inevitable. It will always be a surprise because we don't see it coming, like the earthquakes. We just hope that we don't have any magnitude 9s. And, knock on wood, in California, we've been fortunate, but
so
we know we're overdue.
Thank you. Thank you, Mr. Chair.
Yeah, I just would like Brian Bartow, who really sort of oversees this area, to comment with regard to how rigorous our security is on this, because I know we have a report annually, and it's always very informative and somewhat scary at the same time. Brian.
It is, thank you. So first thing I want to point out that the board has recognized this risk for years. On your risk evaluation and your risk management, it is your number one risk and has been reflected there for a number of years. And one of the reasons it's so high on your risk is really the velocity. And very often we look at the severity and likelihood, but we don't calculate the velocity. And the velocity of the cyber risk is instantaneous. You get biannual reports in closed session from your ISO. That's all because we're protecting personal information, public information. We have a information security office staffed by 20 professionals. We have, we're constantly updating it. We work very closely with our IT professionals. We stay ahead of this. We have other means of protection that we generally talk about in closed session, so we don't alert the bad guys to what we have. But this is in the forefront. This is one of the reasons why it's my responsibility, and we report to you on it regularly. So, and we do work with Chris and his staff for just that very reason, to make sure that our partners are, doing what they're supposed to do. And I know a couple of times we've called in one of the major business partners and said, okay, show us what you're doing. So we're very much aware, and we partner with them as well. This is about 25% of my practice, so I do want you to know that we are definitely on top of this.
So Karen, you can be assured that we're on top of it. Thank you.
Well, we are, but it's just, it's a surprise is a surprise, so.
Yeah. Mr. Ruffino, you have a question?
Thank you, Mr. Chair.
You bet.
And speaking of risk, Chris, thank you for providing the portfolio risk report. Very detailed and very informative. Question, how have the portfolio changes implemented over the past couple of years influenced performance in this challenging time?
Great point, Frank. Credit the investment committee for creating the risk mitigating strategies. For those that haven't been on the board a long time, that portfolio was being developed by the innovation team. They were looking at things that provided risk diversification. 4 years ago, maybe now 6 years ago, the investment committee said, let's make that an asset class and add that to our portfolio. So you have fixed income, which acts as an anchor to windward in the sailing terms. But now you have, more importantly, risk mitigating strategies. And like the name says, it's not a perfect hedge against an economic downturn, but it hedges. And it's got 4 components, and they all act differently to different types of drops. That has done its job. It has actually helped us. And I think that really is going to jump out as a difference between us and our peers. I would not be surprised if Stephen Tong is on the cover of some magazine in 6 months, because people are going to realize the value of that part of the portfolio. And not a lot of our peers have it. A few of the Canadians have it. They don't call it that. There's probably, Alan would know, maybe 5 peers that are his clients, credit Makita and PCA before, that have the type of portfolio. 10% is material, and that has helped. And so not only has it not lost money, I think it's gained a little bit of money already. And so it counterbalances that. The other thing we do in the portfolio is to try and look at that value growth tilt within the equity portfolio, because it is half our assets, and make a decision to lean toward value. We know over long time periods from the work of Fama French, who was a major research at the University of Chicago, that value beats growth over extended periods. We've been in a tremendous growth cycle. You think of Amazon and Netflix and all that crazy, the FANG names, but we've still hung in there. So that value tilt will help us a bit as well. And then obviously, number one tool for us is diversification, not putting all our eggs in one basket. the fact that we have real estate, we have other things to diversify the portfolio. So I think that has helped us in this environment, weather through this storm so far.
Great. Thank you. Thank you, Mr. Chair.
Any other questions? Well, thank you, Chris, for your report. And now you have the great honor of presenting the investment plan for the next year, or next 10-year plan.
Well, business plans for the next year and then a financial plan for 10. Thank you for this. We do this annually in July. Karen reminded me that I used to, and I'll do it again, which is to remind the trustees, this is a handy one to now print and stick on the shelf. Business plans, frankly, we used to design them after Harvard Business School, and they were 9 pages each. They are now slimmed down to try to be 2 pages, double-sided. So it is an executive summary of a business plan, but it is each asset class telling you what their plan is. They all have a common theme because we're one fund and a team together. Our goal is to earn 7%. I put over 20 years, but it is 30 or even longer. We want to beat our benchmarks over the 3-year period. So one's an absolute return of 7, the other's a relative performance goal of benchmarks. Then below that, and I really do want to emphasize, I think we need to keep in mind these other goals are really important, but they are not the number one goal. The number one goal is funding this plan, which has to be the 7. And to do the 7, we have to beat our benchmarks. So below that, though, is keeping our costs down, which is one of your mandates in the state constitution. We're going to talk about that in the Collaborative 2.0 model. The other is a goal you set last September, which is to achieve net zero greenhouse gases in the portfolio at least by 2050. You know, I wish the audience would stay. We say 2050. It's not, you know, zero until year 2049, and then we're going to do something. This is a diet. We have to start right now, and we've already started now. We started several years ago, but now we're measuring it, and it has to be a steady pace so that we get there well, probably before 2050. And then expanding the diversity of the management of our assets. You guys have made those 3 extra goals primary to us, and so while we're making that, beating our benchmarks, we do those other 3. I always like to say to the team, because I'll tell you, some people say that's too much. My point is, if you're think of a great star in anything, singing, music, sports, the greatest of great aren't just good, they achieve it in the face of adversity. And so, you know, I think we can do this and do this well, and we've proven we can. Let me give you some of the sort of simple facts to back up, and I won't read the slide. But yeah, it is, as Karen pointed out, it's an uncertain future. I'm not sure if it's Yogi Berra or Mark Twain, but you know, predictions are difficult, especially ones about the future. So let's recognize that. Alan always says we don't have a crystal ball. But I think the plan over the next 10 years is probably going to grow north of $500 billion. And I think you need to be planning on that so it doesn't surprise us. As much as I'd like to keep it simple, and we're going to push to keep it simple, I can tell from our peers that are north of 500. CPPIB, Canadian Public Pension Plan Investment Board, obviously CalPERS. There's a number of other plans around the world that are bigger than that, and they are immensely more complex as they got bigger. The future work environment, it changed 2 years ago, and it's going to keep changing. I have no idea where we're going to work, how we're going to work, but you know what? Knock on wood, so far we're working, and it's working out okay. And then the collaborative model. We have 2.0, and I want to emphasize, collaborative model 1.0 is already saving you close to $300 million over the last 3 years. We're getting close to where it's going to be saving you $300 million a year, per year. Now we're doing collaborative model 2.0, and then somewhere out there 5 years from now, we'll do collaborative model 3.0. I think that can more than double your savings, and I'll get into the numbers in detail here in a second. One thing I want to emphasize, especially to our new board members, collaboration is a wonderful, nice term. It means something different for each asset class. We picked the word collaboration because it described everything they were doing. Otherwise, we literally would have 9 different words for what this is. For fixed income and equity, it means internalizing assets. For private equity, it means co-investments. For real estate, it means real estate operating companies. Infrastructure and inflation sensitive is still finding out what that means. And at the total fund level, under Scott, it means teaming up with peers. The bottom line is finding new ways to do business that are a little less expensive than what we used to do. And that's what the overall theme of the collaborative model is. So this is a standard deviation. The red line and the blue line are just one standard deviation apart. So when you see that chart, keep in mind that 1/3 of the outcomes could well be above and below that. I try to assume the world's not smooth and even, and there's some recessions and inflation, but you know, those are wide estimates. Now this chart, Karen pointed out, it's really hard to read. It's very small. Let me tell you, really simple. When you look at the two of them, they look almost identical. It's because I'm using the same backdrop of an economy, boom, bust, that kind of thing. What's the nuance between these two? It's hard to see, but in the collaborative model, that blue line is a little thicker and that green line is a little thicker, but the red line comes down a bunch. The blue line is the support budget you approve and send to the Department of Finance and then on to the legislature. Everyone looks at that. Julie Underwood, our CFO, presents that. The green line is continuously appropriated. So the legislature sees that too, but it's continuous. So there's no budget. It's whatever we spend, and that's the contracts we're paying our money managers. So those are personal services contracts, RFPs that we pay our managers, and there are incentive fees in those. The pink area, that's much larger. You actually don't see that. I'll credit Paul Rosensteel as a former board member for demanding we capture that number, which is the incentive fees, the portfolio management fees, and the portfolio carried interest fees. These are partnerships that are allowed and in many cases, hedge funds, infrastructure, real estate, any kind of partnership where they net the fee out before they pay us. That's why we don't think about your mutual fund. Your mutual fund doesn't demand you to write a check to pay their expenses. They net it out of your return. So unless you look at the prospectus, you don't see the fee. It's there, but you don't see it. So I want to emphasize, it's huge. We knew it was huge, but we measured it. Now you get a report on it. It's huge. We pay all the attention to the blue line. That's not the one that's material, frankly, but we pay all our attention to it. That's the one that feels like real dollars to you. So how do we achieve this? There we go. What's the net difference between these? Karen asked when I gave her a briefing on these. The blue area grows by about $15 million over these 10 years. And I can tell you that's two things. It's mostly personnel, and it's going to be higher travel costs because travel's already gone up, but it's going to go up a lot in the collaborative model because we need to meet with people and look at things. But the big one is the personnel. The green goes up by about 25 million that I think we'll end up spending more on consultants and advisors. So if you're willing, let me put it this way to you. If you're willing to spend $40 million, I'll hand you back $750 million. I said it to the students, let me put it simple. You hand me $40, I'll give you $750. Who wants to do that trade? But it's hard. So the 750 is an honest estimate, a very wide estimate. I don't know, but I think honestly that what we're doing right now in the collaborative model, we're getting close to 300 million a year. I think if you fully implement it, you can save $750 million a year, almost $1 billion a year in fee savings by implementing it. What's holding you back from spending that $40? Hard decisions. And you're already starting to balk at them, I'll be honest, because that's things like staff compensation. The three big inputs on that collaborative model are going to be staff, resources. You have to give us the PYs. And you've already done that, and the legislature did that. They gave us a 5-year number of 95 people. But we have to attract them, and then we have to retain them, and that means competitive pay. And I know that's a hard subject for this board, but it means you have to pay them the money so that we can keep those people. And I've told you before, to implement the collaborative model, I need different skills than I have here in Sacramento. And physically here in Sacramento, I need people that have investment banking skills, and they live in different places, and they need different compensation. You also need more consultants. That's easier for you to pay because that comes out of the green line, so not a lot of people see that, but it means, and Gail's already picked up on it, we're starting to hire more consultants to advise us. Mike DeRay can't find those investment banking skills in real estate, so we hired Principal as a consultant to pay them a fee to do that for us. The collaborative model, this trade-off of 40 million versus 750 is not a smooth curve. You can't implement half and get half the savings. It really is an uneven curve. Think of a ski slope backwards or a pipe ramp. You start low and then it climbs up. I guess it's this way for you guys. If you only implement half the collaborative model, you're not going to get half the savings. To get the full savings, we have to be all in and implement all of it. And again, I'm going to say it's going to put you in a hard position to discuss things in public that are uncomfortable, like hiring people and paying them. But you know the equation. You know, I don't want to say it's a 20-to-1 ratio, but it's a big ratio. For every dollar you have to spend in an uncomfortable situation, know that you're getting multiples back from savings in those fee structures. And again, this is all estimations. I can't promise it in blood, but it's estimations. So I already mentioned these. I won't go them again, but those are basically the main areas of Collaborative Model 2.0 that we're looking at across the portfolio. As I said, it means different things in different asset classes, but I think we're doing a darn good job with it so far. The Pillars project is almost done, and it's really helping streamline operations. Milestones or challenges that are ahead, I already said it. Competitive pay, it doesn't have to be the highest, it just has to be competitive. It's subject to the number of opportunities. We need our GPs to show these in. To do business different than a partnership, they make a lot of money in a partnership. So they have to have some motivation to do something different than a partnership. And we have to be a good partner that they want to pick us, frankly, versus CPPIB or Government of Singapore or ADIA, which is Abu Dhabi. It does mean more risk because it means larger bite sizes, but it also means more control. We're less of a passive portfolio, a limited partner. We're more of an active owner. And I wanted to point out the other big risk is we're going to be doing all this while we're going to have a massive global energy transition, which is going to really dominate our attention. The business plans are all here. I'm not going to go through them, but the directors are all ready to jump up and come up with any questions you might have about any of those. I'll answer the questions about the 10-year financial plan.
I think there are a couple of questions about the presentation that you just gave, Chris. Ms. Miller.
Thank you, Mr. Chair. So a few questions. You know, you've come a long way with the collaborative model. The collaborative model is becoming a little bit like the reason we talk about a lot of things. So I'm going to correct a couple things and then ask a few questions. One, a continuous appropriation is an appropriation. It comes out of the same money. It takes, you know, there's always a trade-off. There's a finite amount of money in California. There's only a certain amount we can spend on everything from K-12 education to the pension funds to healthcare. So the idea that a continuous appropriation is any less money than anything else is just inaccurate, respectfully. So really important that we understand that all the expenses are a trade-off of something else. And you know that better than anyone because of the members we're trying to serve. So I think that, the collaborative model is a way not so much to necessarily talk about the state, but to make sure that we are keeping our members whole in any way we can. We just talked about our 3-year smoothing, which hopefully we have. It's still our obligation to meet that 7% return. It's the only way it worked. All of you understand that if you're post-PEPRA, the contributions you have to make will change if we don't get this right. Part of getting it right is the collaborative model. So first, when we talk about savings, and I know that we work on this all the time, but whether or not it's net of expenses is a really important issue, and it's not clear to me that it is. So I do think we need to refine that and get closer and closer to what the 300 million means. And it's really important because we can't use collaborative model as the answer for everything until our data is entirely precise. 2, on the consultant question, consultants are just as much of an issue as managers and co-investors. So understanding the costs that we are incurring, understanding that they're outside of the board's purview, but including that in a cost report is going to be really important because in some ways, as important and as necessary as consultants are, they are supplanting in a very creative way what we were doing and paying for with the managers. So those, I think, are 2 really important requests as we go to a cost report. And 3, on compensation. So first and foremost, I think it's really important that everyone understands how grateful the board is to the incredible service of the investment team. There is no question about that, and no conversation about compensation should ever be construed as anything but looking at the fund writ large and looking at what exactly it takes to make sure that we're keeping folks whole, and by folks I mean our members, always having that top of mind. And so I think there's a few things that are important. One, it's how the board views whole compensation versus the long-term incentive plan. So I think there's a lot of work that is being done and needs to be done. No one ever thought this would be fast, but I'd like to signal clearly that compensation is more about the whole package than it is about whether we consider a long-term incentive plan. And part of the work we're doing on benchmarks, and quite frankly, part of the work that should go back to you as the investment director around compensation, and this is a question for Mr. Emkin, is an important part of what compensation looks like and how to meet that challenge. And the second thing that these are all civil servants, Mr. Ailman, and they are all collectively bargained. Nobody knows that better than the teachers on this board. And so it's not as clear as a simple decision here at the board level. It is a lot more complicated than that. We are working towards, I think, a shared goal, but really understanding that and understanding the nuance, I think, is important because I think there is no lack of dedication from this board and support to making sure that we can execute on the collaborative model in order to ensure certainty to our members. But I just don't want there to be any mistake because I again, respectfully think you did oversimplify some of the issues around compensation. We have a job to do. I think that Mr. Emkin and Makita are going to help us get there with the benchmarks. But I also don't want to mistake the multiple steps in the process that it takes in order to bring that expertise in-house. And I 100% agree with you that we're better off having it in-house than we are continuing to outsource it, and how we get there is important. But while we've been doing all of this, we've also been increasing costs that we are paying in terms of consultants. So just making sure that that's all a balance, I do think is really important. So I think just to summarize, one, just to always have top of mind that we are a collectively bargained state that often doesn't have as much to do with the board as it does with the entire state of California. 2 requests on the costs. One is our savings net of expenses and how we net out expenses. I know this is a tough one for Ms. Wilcox, and I apologize. And 2 is how we can incorporate the consultants into the cost modeling and make sure that we're constantly aware of that trade-off. And I would just ask, with permission of the chair, if Mr. Emkin wanted to comment on any of that, and just an update on where we are with the benchmarks, which, as you'll see in these plans, we list, probably a couple hundred of them, and how we can simplify that and how that could potentially help with our entire compensation structure for the board.
Mr. Emkin.
Thank you once again, Alan Emkin, Makita Investment Group. Responding to the question, we did a survey of the board. The survey very, very clearly said there was a belief that the benchmarks were far too complex and were difficult to understand. And that gets directly reflected in the compensation scheme because you have to be measured against something. And the current benchmarks are challenging. And so our objective is to come back in the fall with the staff, providing you with some alternatives that are clearly transparent, that are intuitive, and that are consistent with the concepts behind a collaborative model. And the key is really to meld these different things so there's consistency. And once you have benchmarks, it's a lot easier then to go about constructing a compensation scheme because you know what you're measuring it against. I hope that answers the question, Ms. Miller.
Yeah, so you think the fall you'll have a proposal for the simplification?
The goal would be to bring you alternatives so that you can give us direction on how to refine it.
Yeah. Okay, thank you very much. The next question comes from Mr. Ruffino.
Thank you. Thank you, Mr. Chair. So, Chris, I know you asked the students whether they want to take the trade. I'm not sure how many raised their hands, but I'm the first board member that raised my hand, so I'll take that trade any time of the day. No, but on a serious note, I know that you identify, and by the way, before I ask the question too, I know the collaborative model, notwithstanding the concerns that have been raised by Ms. Muellers and others during our discussions, it is, and it's worth repeating, it is an accomplishment and something to be proud of. The savings that we already have identified and the savings that we project in collaborative model 2 and 3, they're huge. And it's worth all the efforts and all the hard work. That said, my question is about the challenges to achieve. And I know you kind of touched base on some of the challenges. I mean, from earning the actuary required, from achieving net zero to the collaborative. I mean, I know you kind of touch base, but can you, if you were to prioritize, if you were to say, this is our number one challenge to achieve the goal layout in the business plan, what would it be? And can you be a little more specifics on how we prepare ourselves for these challenges? Thank you.
Thank you, Mr. Ruffino. If I look at this list that I created, it's in your PowerPoints. I'm going to put number 2 or whatever, bullet point 2 is number 1. First, we have to have the opportunities. We've got to have our general partners willing to show us co-investments. We already know well that Texas Teachers is doing this. CalPERS is talking about it. The Canadians are all doing it. And so there's already, and sovereign wealth funds do it. And I've told you, they're bigger than us. We're probably number 25 in the world among that group. So GPs give away co-investments based on the size of the partnership investment, the depth of the relationship. I'll give you a live example. Last year, our best returning investment was when Tom Baker, who's sitting upstairs in the private equity team, read in the paper that one of our firms was going to buy a company, picked up the phone, called the GP because he knew him well enough and said, we want in that deal. You've got to show us that as a co-investment. And they did. And I don't remember, Margot, 11 times our money? Not that big.
Less than 5.
Less than 5. All right. I exaggerated. I dreamt 11. So 5 times, close to 5 times our money. Oh, Tom is there. Wave your hand, Tom, so I know who the heck you are. There he is. He's blushing.
Keep reading the paper.
Keep reading the paper, yeah. But, I can tell you for a fact, if you have lots of turnover in the staff, the GPs don't like that and they don't know who people are. It is somewhat of a relationship business. That said, I need to introduce the team that Margot and Rob Ross have been able to hire to do the co-investment portfolio. They're phenomenal. But they're all new in the pandemic, and like that, we've hired 65 people during the pandemic. We hardly ever see them in the flesh, in person. So I need to find a way to bring them in to introduce them like we do with the students. But we've got to get those opportunities. Reox, Mike will tell you that he's been fortunate in buying the 3 real estate companies we have, but they don't knock on our door every day. The risk and the legal oversight is probably as high up there as competitive pay. And I want to be clear, I'm not saying any kind of pay. It just has to be competitive, and it doesn't have to be the top and the highest. It just has to be competitive so we can retain these people. And it's a tough competitive market, unfortunately. And then I think technology, I think we're going to get our hands on that, but we have to have the same kinds of tracking and accounting and technology almost that a Goldman Sachs or a Morgan Stanley, a JP Morgan, an investment bank would have. And that does mean advisors, and because we own companies outright. We have a 95% share ownership of a real estate company who has a CEO who makes a lot more than I do, has a board. We have a staff person on that board, but we have to have oversight of that company so that we know they're doing the right thing and not messing up our investment. And that just takes different challenges. So I would say, Frank, the opportunity set has to be there, number one. Tied with legal oversight and risk is going to be, you've got to hire and retain the right people and keep them. Then technology next. And then you're right. As Alan and I would remind you, this isn't the 1980s and 90s. We thought things were volatile back then, but now we look back at it and we're like, oh my gosh, the wind was in our back. It was 70 degrees and a lovely day every day. What a positive market. The world is so complex and so uncertain that will be a challenge, and it may mess us up along the way.
Thank you, Chris.
Can I just do a quick follow-up, Mr. Chair?
I'm sorry.
Yeah, just a quick follow-up?
Yeah.
Thank you. So what should be viewed as a reasonable stretch goal?
I'll go back to this slide. And Ms. Miller is 100% correct, so I don't want to disagree. She is correct in catching my simplifications. Everything on that chart comes out of this trust fund. The state pays in, the members pay in, and the school districts pay in a ton. And like Bill likes to say, 60 cents of that benefit dollar has to come from investments. But this is the evaporation off that balance while it's there. It's the costs. And you're right, the green line is continuous. It's expense. We pay it. So a stretch goal would be to see the savings exceed $1 billion, and so you'd have more than half of the private equity portfolio in co-investments. You'd have more than half of the real estate portfolio in real estate operating companies we own. I don't know that we could ever get there in infrastructure, but the Canadian plans that we look to, and we can't copy them. I just want to be clear on that. We don't have the right structures and governance, and we haven't privatized. They own their head of real estate is the CEO of a real estate firm. He owns a 2,000 person company. Same thing in British Columbia, where they merged all their real estate managers and owned one company and hired those people. I don't know if a U.S. fund like us could ever get there, but that would be the ultimate stretch, that you would own an investment management company, and that would almost be your staff. So there are models out there, so we know this is not unproven territory, but you got to have a lot of different things, a lot of different legal structures set up to do that. And our governance with the state
Thank you, Mr.
isn't going to work.
I'm delighted to give Controller Yee the next question.
Okay. Thank you, Mr. Chairman. I want to just make an observation about staffing, because I think I'm actually finding the staffing issue to become more and more of an issue that I'm associating with and really tying to kind of overall portfolio risk. And a lot of it really has to do with where are we finding our talent in the future? I don't think it's between pension funds anymore. I think it's a much broader arena because of the way the world is changing. And I mean, I'm seeing just how complex this portfolio has even gotten since I've been on this board. And, you know, the need for data analytics and just, you know, working with big data and how we're going to manage, you know, kind of risk going forward in a more complex environment suggests to me that we have the need to recruit talent, not just by poaching from other funds, but frankly, to really look at the talent that we're going to need to sustain this fund for the future. I mean, we talked about the future of work earlier, and the future of work is here with this fund. And so I don't want to have kind of the staffing issue become a limited discussion of where we're trying to deal with what we need now. It really should be, I think, risk-driven in terms of what we see as the needs for how we're going to manage more complex risk going forward, and also with the realization that, and I completely agree with Member Miller. I mean, this is we're in this environment of where we are, you know, kind of a civil service state, and so I am very respectful of that. I've had to, frankly, live with constraints for the past 8 years myself, and we did it. But it was tough, and we've lost people. So I think we have to face the harsh reality of what this means, but I want us to be future-oriented about it from a risk perspective. And so I hope that we can actually start to define what some of the questions are that we want to ask and have explored relative to staffing and compensation, hopefully before I leave this board, because I do think the world is changing quickly. And I don't want to be dealing with this issue when the risk is, like, frankly, front and center before us. So I think there are thoughtful ways to start the conversation. I've not been happy, frankly, with how other funds have been having this conversation because it's not been a future-oriented conversation. So I would just encourage my colleagues to think about it from a risk perspective because, I mean, look, we're the second largest public pension fund in the United States. I hope we can behave like that in terms of the talent that we can have here to really manage and sustain the fund. Thank you.
Thank you, Betty. I just would like to add that I'm, once again, in agreement with Controller Yee. When you do think about our obligation to pay pension benefits to those who spend their lives teaching the children of this state, the young people of this state, and who do so as professionals and compensated and acknowledged not in a professional way. One of the benefits, one of the significant benefits that they do have is the defined benefit that we are charged to provide. And no one can argue with the fact that 60 cents right now of every dollar spent comes from investments. So when you talk about our risks in terms of providing those benefits to a retiree, it's in human capital. It's in human capital. And so we have to acknowledge that. And we have to realize that, you know, we do, as Controller Yee has observed, have to come into the 21st century and realize that, you know, it is going to become much more difficult. The risks that we face today are extraordinarily more complex than those wonderful windy, but wind in your sails days of the 70s and 80s. And so I hope this board does think carefully about the importance of this issue. And I hope that with your participation, staff's participation, we can come up with a plan that can not only attract, but retain good people, the kind of people that we need to be competitive and to increase that 60 cents to maybe 65 cents of every dollar and move it up so that we take that burden off the employer, the employee, and the state. And I think it's a good investment. So anyway, thank you for your report. If there are no other questions, we'll move on to the next issue. Next agenda item is number 6, inflation-sensitive asset class policies, first reading. And it's Paul Shanek and Charles Fitzpatrick.
Got 2 policies in front of you. After 8 drafts of this slide, I tried to simplify what we were doing because there's a lot of moving parts in the policies. But really what we're trying to do is clarify processes in the inflation-sensitive policy as we've expanded aspects of that policy. We have processes that we have taken in from the infrastructure part of our portfolio that have become kind of a part of what we do overall in the inflation-sensitive unit. So this is just to recognize some of those processes in terms of how we do investment approvals internally and talk about the portfolio in terms of policy language. The second thing we've done is slightly adjust some of the ranges around allocations and concentrations in the portfolio. That's the movement from 20 to 25% with one manager, and we've still kept limits in terms of 5% in any one asset. We have those in both policies now too. We moved the debt part of the portfolio into the inflation-sensitive policy, and we want to keep that over there because the debt side of the portfolio in inflation-sensitive will be the kinds of assets that float with inflation for the most part. And then we wanted to ensure consistent policy language. As you know, the policies have morphed over the last few years. So the RCP language in the environmental liability was pretty much taken from the real estate policy, which you adopted a little while ago. We have sections of that in our policy, and so we made those adjustments in the policy. So there's a lot of tinkering on the edges in this policy. There are no major movements or changes overall in how we do things. It was time to make these changes and bring them to you and move on. With that, this is a first reading. You can adopt the policy at this meeting, or I can bring it back for a second reading. And we're here for questions.
Are there any questions? And would anyone want to move adoption of this? Okay, Jennifer.
Move the motion. I do have one question just to understand the context. As we look at the inflation-sensitive allocation relative to the total portfolio and in the spirit of collaboration, and we think of the roll-in portfolio, could you just give us a little color? I realize it's a bit off the topic of just the policy itself, but the coordination on the inflation-sensitive, on the debt-related aspects of it, and how that relates as you are interacting with your equity, private equity, fixed income real estate.
In terms of how we're thinking about the portfolio, about 50 to 60% of the portfolio is found in infrastructure. That's supposed to be, and for the most part, should move with inflation. It'll be delayed, but there is adjustments that occur with the assets that are owned. Not every single one is linked to inflation, but a good chunk of them are. So that's why that resides there. So that's kind of the steadfastness part of the portfolio that moves up a little bit and it produces income along the way too. Outside of that, we have commodities. We also have the TIPS portfolio. Both of those we run with the assistance of fixed income in the portfolio. As you know, since inflation's increased, the commodities portion of our portfolio has hit its limits, so we can't increase that anymore. On the other hand, as inflation starts to drop, as we expect at some point, the TIPS portfolio will do better. So there's like a little bit of a balance there. The other aspect to this in terms of the debt that we're talking about is we're looking at a couple of debt strategies. Private debt, not public debt. So a little bit more return in the portfolio so that we can have that part and have more things adjust in the portfolio. In other words, more things to choose from in terms of adjusting the portfolio to inflation over time. So that's why we wanted to move the debt over into the inflation sensitive side so we can look at managers and strategies across a broad spectrum. But to start out, since we're mostly, we started with infrastructure and inflation sensitive, we're looking at the potential of infrastructure managers on the private side and the debt that they issue for those. So that's why we want to kind of move things over into that bucket.
And that debt would be primarily floating rate.
Yeah, and there can be some short duration, so short maturity debt that will roll over enough to capture some of the inflation, either upside or downside, that could occur.
Thank you. And I am prepared to move if we're at it.
There's been a motion by Ms. Erden, second by Ms. Miller. All in favor? We'll take that. I'll learn. One of these days I'll learn. We'll take that roll call.
Ms. Bradford? Yes. Mr. Gunning? Aye. Mr. Tang?
Yes.
Ms. Erden?
Yes.
Ms. Yamamoto?
Aye.
Ms. Miller?
Aye.
Mr. Rufino?
Yes.
Mr. Johnson?
Yes.
Controller Yi?
Aye.
Chairperson Prezant, would you care to vote?
Yes.
Motion passes.
Thank you very much for your presentation. And okay, now we go.
That was 6B and A?
6A. Oh, I'm sorry. Thank you. Infrastructure policy investment revision. Was that?
I believe they covered both.
Are they? Did you address both?
Yes, I thought I had done that.
Yeah. And you moved for A and B?
A.
I moved for A and B. Maybe we want to make voted for A and B, but.
Anybody?
Yeah.
Would you?
No, I'm going to keep my vote, but I just wanted to make sure that that's what we were voting on.
That's what I thought we were voting on, so. I'm sorry.
But I'm okay on the vote.
Yeah, the vote stands, but there's a question from Controller Yi on portion B. Paul?
So Paul, I was just curious whether you've seen increasing competition for value-added assets as demand remains high for the core investments.
I would say overall we have seen competition overall, but when core assets come up in particular, they're usually big, and there's definitely a lot of large funds out there that need to fill them, need to make investments. So that's why we backed a little bit off of that. The value add part of the infrastructure world is pretty big, and value add could be defined a number of different ways in terms of just tweaking a company or an asset around the edges versus making a major capital investment in it. So there's more of those, and so there's a chance to diversify your portfolio much more broadly.
And how many external managers are we working with?
I think it's, I want to say 10 or 11, I think it's in my business plan, that we're working with in the portfolio. But within that, what we're trying to do is we're trying to establish, using collaborative model, a relationship so that we understand what they do, how they do it, and when they're looking for either their next fund or to establish an account, we're behind them ready to go. So we're not trying to spray the world with a number of funds. We're trying to keep it concentrated. That becomes harder as you get bigger, and we realize we're going to have to move outside of those bounds. But the idea is to develop those relationships and understand those managers and what they do really well.
Good. Thank you, Mr.
Well,
Chair.
Paul, since you're up here, I have another question for you. I noticed on the ISR report during the plan that they have approached a general partner that purchases royalties and from commodities. Is that part of the collaborative approach? I mean,
Internally, it is actually, I've sat in and another member of my staff have sat in on their investment review committees for that asset. So we've, I think they've second fund that you guys are on or something like that in ISR, but we've actually internally are aware of what they do and how that works in the portfolio. We're not in day-to-day contact with it, but it was from the standpoint of commodities, that's what made it interesting, and Geraldine asked us to sit in on that, so we've done that.
Geraldine?
Yeah. Just wanted to add, there was actually maybe two components of collaborative model. There are co-investments, and we have revenue share there, so it's a collaborative model, but it's also a collaborative model within the branch. Like, we saw an opportunity, it kind of fits in the innovative portfolio, but they're obviously the experts in that area, so we work together on due diligence and oversight and recommending.
Great, thank you.
Can you, just for the rest of the board, describe that investment a little bit? We're in open session, so not too much detail, but.
Yeah, so it has to do with metals and mining. It has a lot to do with the low carbon future, investing in minerals that contribute to that. So it's more of a lending strategy. So they lend to these type of investors that actually find these minerals. So it has a little bit of a commodity exposure, but it's also more of a private debt exposure.
Interesting. Yeah, very interesting. Thank you. Okay.
I just have a question.
Karen? I'm sorry.
I think there was.
The motion was for both 6A and B.
So the board, the committee approved the inflation-sensitive policy revisions as well as the infrastructure policy revisions.
That's correct.
Thank you.
You bet. And Karen, you have a question?
Yeah, just clarifying. After looking at the business plans that were part of the chief investment officer's report, it indicates inflation-sensitive as an asset class. Okay. So now I'm really confused as to why 6B has their own infrastructure investment policy plan as well. And where does that fit in the scheme of the whole business plan area?
Infrastructure policy, the units pretty much started out as infrastructure.
Right.
So that's its pedigree. And between, like I said, between 50 to 70% of that over time will be infrastructure. And that's going to move around as, in this case, commodities became an interesting market to be. So we flexed to doing more commodities in the portfolio. In terms of the recognition of inflation sensitive, if you say private equity and real estate to somebody in your positions, everybody knows what that is. If you say inflation sensitive, that can mean a bunch of different things to different funds, to different people. So infrastructure is where we started. That is where, in terms of focusing recruitment, that we want to find people. And they recognize infrastructure within that. So that's why we have the infrastructure policy. That's where we started. And from there, we've expanded that into inflation sensitive. And as we've gained more people, we will devote more resources to the inflation sensitive side in terms of other strategies besides the commodities and tips that we have now. So we'll have time to investigate more of those. But we needed over the last few years to ramp ourselves up and to get going. And so we focused on infrastructure and the portfolio, and that's going to be a continued emphasis for us going forward.
So it resides in the inflation sensitive?
Yes.
Okay.
It's a major piece of what we do.
Okay, but we still had to do a separate policy for both of those.
The infrastructure policy came first years ago, and the inflation sensitive policy followed after that.
Okay.
So yeah, we've talked about merging the policies, and then it becomes quite a big pile of spaghetti trying to figure out how to do all that. So it's been much easier for us to say, in reference, the inflation-sensitive policy serves as a broad umbrella under which infrastructure sits. It's one of the unique things about the asset class versus other asset classes.
So this part of the whole rewrite, I guess, of our IPMP will be the IPS, right? that Geraldine talked about earlier.
Yeah,
in
that's
another-
Chris Elman, Chief Investment Officer. That's higher level. So like
Okay.
Paul said, it's inflation sensitive, it's the parent, infrastructure is the child. The overall investment policy management plan, IPMP, drives all these policies. They're all underneath that. That's your big overall instructions to us. It was a shiny, awesome car, brand new in 1984. And we've kept it up. It looks really good, but we need a modern model. So we want to shift to, most people don't have an IPMP, they have an IPS, an investment policy statement. That's our governing document. So we really want to take our time revising that, modernizing it. All of these and asset classes, Karen, would be subservient to that. That would be the overall. We're probably using too many I's and the initials of P and S, but yes. So you still have an investment policy, you have investment strategy, inflation sensitive. We have lots of acronyms.
Thanks for the clarification.
Thank you, Karen. Okay, we now go to the consent agenda. Number 7, fiscal year 22. Chris, do you want to just sort of address that for us?
I would be happy to. This is really the guiding document that guides the committee. And it helps. I really want to emphasize this is a good chance for all of you to chime in and see if you want to add stuff. It's not uncommon to have issues come up in January or in October that suddenly dominate the headlines. And to keep us from dropping what we're doing and suddenly dealing with another thing, we have this work plan. And you can add items to the agenda, but generally this is going to guide. You've got Makita, you've got RCLCO, you've got us, you've got a lot of people. It's marshaling us all together. The collaborative model and the transition to net zero are going to be on there for a long time because they are multi-year, decade-long efforts. But we also wanted to take on at least one other project. We really, I've found historically, cannot do more than 2 or 3 major projects with the committee because managing the portfolio takes so much time and attention. But the major project for next year is the asset liability review, as everybody has said. And I have to pay $1 every time I say this. It is the single most important decision you make. It differentiates your return from everyone else in the world. We're going to start in September a little, but mostly at the offsite in October. We'd like to take half of your day and really talk about geopolitical risks, kind of like, we always talk about 1 standard deviation. We actually want to talk about some of the 2 standard deviation, really scary things. Doesn't help to talk about, the wonderful Goldilocks, everything's perfect. We know that's going to be good, but let's talk about scary stuff like China, Taiwan, obviously the energy transition, global pandemics, and how that can impact the portfolio. Hopefully we won't have nightmares after that offsite, but we do want to talk about hard stuff. We'll then go into November and on into the traditional asset allocation study. You'll need to pick asset classes, which ones you want or don't want. And then you have to establish limits. Alan and I have done this for 40 years with different clients. And we're going to do the traditional asset liability study. There are different methods, but we're merging up with Rick Reed and David Lamoureux, the actuaries, to make sure that what they're doing on the liability side links with us. I think probably the toughest decision you're going to have to make is inflation. It's not necessarily a hard decision. The numbers are there, but it's just been so unusual lately. We'll look at history. We'll try and predict the future. The inflation number we want to roughly link between investments and what the actuaries use for the liabilities. That way we're linked. Our ALM studies take usually about 9 months, so I think we'll probably aim to end next July with you picking a new asset liability, certainly a new asset allocation. And then as you've just seen earlier today, we allow ourselves a couple of years to shift the boat to tack to that new asset allocation target. But hopefully you'll find it very robust. It is very academic. In the end of the day, you're trying to predict how the market's going to behave in the future, and we know that's impossible. So all we can do is look at the past and extrapolate that and make reasonable assumptions. The one positive I can tell you is virtually all of your global peers that run defined benefit plans have to do the same thing and use the same tools. So we're in the herd that way. But that would be the main thing that would dominate your agenda. September will be your semi-annual performance. It will be a heavy meeting because we will also be doing an update on your transition plan to net zero. I want to shift the heaviness of that meeting to where it's annually in May. We think that's a better time because then you can pick up December 31 information. And this will all shift if you change your 23 schedule. But March and September are always going to be heavy meetings for you. And now May will always be a heavy meeting because that will be very focused in on climate.
If I can just ask, given the fact that this is the most important decision this board makes, and given the fact that we are living in a time that has certain challenges, I'd like if Mr. Emken would provide us his perspective on what challenges that we might have in terms of this plan and the importance of this plan given those challenges.
Mr. Chair, in my opinion, the biggest challenge is the recognition that we don't know the future and that you have to make a decision under uncertainty. And the range of outcomes is so broad that we use estimates, and around those estimates are ranges. And where you fall within that range, no one knows. And if anyone really had that information, they wouldn't share it. They'd only use it for their own portfolio. But once you accept that uncertainty, then you use generally accepted tools to make prudent decisions based upon the facts and circumstances as they exist. The challenge is none of you nor anyone in my world is used to dealing with $300 billion growing to $500 billion. And it's an enormous responsibility. And as you say, Mr. Chairman, it directly impacts the members of the system and their families. And so it's just a huge responsibility. And it's one that you voluntarily taken, except for those of you who are elected. And it's the most important thing that you can do, because it will, in fact, have the largest impact on the risk and return of the portfolio. I hope that, at least in part, addresses your question, Mr. Chair.
I guess my follow-up question would be, given the world's situation, do you see this as less complex or more complex than what we've seen in the last 20 years?
In my opinion, it is no different than anything you've done before, with just a different set of factors and characters. There is one redeeming factor, though, and that is, by definition, you're going to redo this in a limited period of time to reflect any errors you may have made in the decision-making process. So it's not a once and done. It's an evolution. It's a dynamic process. And not only will the assets change, the liabilities will change. And so you, on a regular basis, as good governance, as best practice, undertake this whole thing all over again in just a few years.
Thank you. All right, let's move on. Karen, I'm sorry.
Well, I just have a quick question. Well, thank you. A lot of work to be done, and cheers to the staff who are committed to do it. I just have a, on the April offsite, if my memory serves me correctly, we don't have that anymore. Is that true? We crossed that out. So it's on this plan. So we're going to fix it, right? Okay, thank you. That's all.
Okay. Any other questions? Okay, moving on to the next item, approval of the minutes from the meeting on May 5th, Any changes or corrections, Karen?
They've been made.
Mr. Chair, I'm sorry to interrupt you, but we do need a consent approval on the item 7.
Oh,
And that could
okay.
just be a, that could
Oh,
just
I'll
be
get
a-
consent,
before you
yes.
start.
Any objection? Without objection, it's consented.
Thank you.
Approval of minutes. Any changes, corrections, or additions? Without such,
Oh, that's a consent action.
it is consented. Report pursuant to Assembly Bill 2833. Chris, is that you that is going to address it? I mean, it's a list of the obligations under statute that we have to perform.
Yes, sir. 9 and 10 are under consent, so if there are questions, we'll bring staff up, but otherwise, they're just provided to you to receive.
Well, let's just do one at a time. Any questions about item number 9? Without objection, it is so consented. Item number 10, annual review of delegation to staff. Questions? Any objection? Without objection, it is consented to. Information items, review of information requests. I don't think there were any information requests.
I had possibly one from Ms. Miller.
Oh, that's right. I'm sorry.
She can clarify if it was an actual request. It was regarding a request for a cost breakdown with respect to the consultants, and to incorporate those consultants into the cost modeling. Is that correct? And then she also had requested a report as to whether the savings are net of expenses. That's what I have. Right.
Great, thank you. We have scheduled a break, so why don't we take a 10-minute break and be back at 11:30.
Do you want to do it?
Item 12 on mine is as break.
Oh, open session for the draft agenda. Do we talk about?
Yeah, the draft agenda. We opened with it. Yeah.
No, the draft agenda for the next meeting.
Oh. I don't have it on my list here. Oh, draft agenda. Excuse me, once again, this is a novice's approach. Gail? The draft agenda for the next meeting? Any changes to the draft agenda?
Chris.
Chris, do you have any changes? Without objection, it is consented to. We'll take a break. Thanks.
Ms. Bradford? For the Director of Finance, Ms. Miller? For the State Treasurer, Mr. Ruffino?
Present.
For the Superintendent of Public Instruction, Mr. Johnson?
Here.
Controller Yi, you have a quorum present.
Thank you so much, Trevor.
And
Oh, and Ms. Yamamoto.
I don't have Ms. Yamamoto on the committee.
No, you're not on the committee?
Well, let's reflect you as here and
Yes.
we can straighten that out.
Why don't we, just for the record, note that Ms. Yamamoto, Mr. Tang, Ms. Erden, and Mr. Gunning are also here present with us. Great.
So noted.
Thank you very much and welcome to all of you.
And now that roll has been called, I have a statement regarding public comment.
Please. Yes, Trevor.
The CalSTRS board meetings are live web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for a 10-minute public comment period at the end of the agenda item the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared.
Thank you very much, Trevor. All right, members, our next item is approval of the committee agenda. Any questions or comments on that? Excellent. Without objection, we will approve that. And before we move on, I'd like to also welcome our Vice Chair of the Audits and Risk Management Committee, that's Denise Bradford, and just really looking forward to working with her for the remainder of the year. And welcome, Denise. Next item, members, I'm going to pull item number 3 off of the consent agenda for a bit of presentation and discussion. So next item will be the consent agenda action item, approval of the minutes of the March 3rd, 2022 ARM Committee meeting, open session. Karen, did you have a chance to take a look at these by chance? Any questions or comments on that? Seeing none, that's a consent item without objection. The minutes of that open session meeting of March 3rd, 2022 will be approved. So item number 3, I really just want to take an opportunity to welcome our new Chief of Audits, and that is Cheryl Cervantes Dietz, who is a familiar face to all of us, who has been building up and lifting up our compliance operation. And Cheryl, welcome. Really happy to see you in your new capacity.
Thank you. I appreciate it.
Great. And so we have item number three before us. This is the progress report. And the reason, members, I pulled it off the consent agenda is that oftentimes we don't have an opportunity to follow on to just look at what kind of progress we're making on management letters that our auditors issue, and want to be sure that we are kind of circling back and being sure that there is progress made on some of the findings. And so, Cheryl, you want to present this and just give us an update?
Sure. So as Chair Yee mentioned, that this is management's progress on implementing a recommendation from Crowe, our independent auditor, on the progress we made on the one deficiency they noted related to internal controls over member data. So just to give you brief background, because I know there are some new members here. In November 2021, Crowe presented to the committee the financial statement audit as well as the report on internal controls for financial reporting. And then they also issued a management letter on a deficiency that did not rise to a report that needed to be communicated to you, but instead was reported to management. So it's CalSTR's practice to go ahead and be transparent and share that with the committee. So they did that in November, and then Audit Services provides progress report on how they're progressing through that, implementing the recommendations. So as you can see in the agenda item, they've made progress on implementing those recommendations, but I also invited Jeff Zimmer from Employer Services to come on up and provide a little bit more detail on the progress and also answer any questions you may have.
Good afternoon, members of the committee. I'm Jeff Zimmer, Director of Employer Services, and I appreciate the opportunity to comment on the management letter. As you know, our employer partners have the ultimate responsibility to report accurate contribution data to us. And as you've heard consistently from Crowe and Dr. Yetman, our mission will always be to improve the accuracy and reduce the risk of error regarding that data. So we continue to evolve and augment our processes and efforts, and the management letter describes some of those. It highlights both recent improvements and some new areas of opportunity. The recent improvements are redistributing some of the workload amongst our teams to better serve the needs of our report sources, also to institute a post-audit review 6 months after a completed audit, and also to consolidate the most complex employer inquiries to our training and development team. So the letter also lays the foundation for future improvements regarding quality management, a pre-benefit account review, and audit resolution. And through our budget concept proposal process for the fiscal year 2023-2024, we've requested 15 resources to support these efforts. And the board in September will see those resources as part of the budget, next year's budget request. So to fully implement all of these ideas and move them from pilot to program, because we're currently piloting them, we actually requested 28 resources. Management thought it prudent to start with the 15 and understand and develop the processes and fully comprehend the workload that could potentially justify future resources in longer years. So this is the first step of a multi-year approach. And of course, we continue to focus on providing and improving education, job aids, outreach, and service to our employer partners, and we'll always continue to improve that. Lastly, tomorrow, the board will hear a very, very brief update on Assembly Bill 1667. And that's a stakeholder proposal to address overpayment liability and other reporting and audit-related topics. The items in the management letter were considered and planned independent of that legislation. So should it pass, we would evaluate our resource request and our current resources to see how they overlap with those legislative mandates. And all CalSTRS business areas impacted by the legislation would assess their resources and processes should it pass and the resources need to make sure we fully administer that legislation. So just wanted to put that in there as an aside. So that was a brief update on the letter, and I'm happy to answer any questions that you have.
Thank you so much, Jess, for the update. I'm going to turn to Dr. Yetman for some comments, and members, particularly our newer members. Dr. Yetman is the financial advisor to this committee, who always is so willing, and we're very happy to have him provide just another independent eye to the work of this committee. Dr. Yetman, on this item.
Thanks, Jeff. Excuse me. Thank you for coming up.
Of course.
As you know, the board tries to keep a sharp eye on these issues, and you're exactly right. It is the employer's responsibility to provide accurate data to the organization. But with so many different organizations reporting data, with a variety of reporting requirements, with ever-changing reporting requirements and ever-changing staff at the school district level, mistakes are made and mistakes will continue to be made. I think expecting zero mistakes in this space is just simply not realistic. Nonetheless, I'd like to applaud the audits that you guys have done. I especially like the after an audit is done, whether it's a desk or a correspondence or any type of audit, you take those findings and go back and say, because we tend to find the same things again, as you know, right? And they circle back, and what they do is they try to communicate with them and say, hey, we find these mistakes very frequently, and it gives us an opportunity to not only work with that school district, but with all school districts that didn't even get audited, and put together little keys or educational components to work with them to say, these are things we're finding you're getting wrong more often than not. And we're going to look at it when we audit you, so you may as well fix it now, because we're gonna find it. So I really applaud those efforts, and I thank you for that. With respect to the budget request, is that a full board thing? Forgive me for not knowing the workings.
Yes.
Okay. Controller Yee, I'll work with, we'll talk. Yes, ma'am. Okay. That's all I have. Thank you, ma'am.
Thank you, Dr. Yetman. Let me see if members have any questions or comments on this item. Thank you so much. Just wanted to provide that context so that in advance of when we see the actual budget change proposal. Thank you. Thank you so much. All right, our next items are two informational items. The first will be the mid-year progress report on our 2022 Enterprise Compliance Services Plan. And Cheryl, that is you. You're wearing lots of hats today.
Yes, since I created the agenda, that I present on it. So basically, Enterprise Compliance Services was under Audit Services, and since our last meeting in April, we moved under Financial Services Branch. So Enterprise Compliance Services now reports to the CFO. This move really allows for improved collaboration and synchronization of compliance activities with ERM, and will help the organization continue to mature and strengthen our compliance and risk culture. So because we moved, I'm still under Enterprise Compliance Services moved under Financial Services Branch, one of the first things that we performed was a review of the program charter. So that program charter has been updated to align and be consistent with the Enterprise Risk Management Program Charter, and also to address the new reporting structure. So that charter is currently undergoing review, and we go to Julie, and then it'll go to the Executive Risk Committee for review and approval. So as far as our compliance plan activities, we're making progress on it, but I really wanted to take the time today to really just focus on the revised CalSTRS Code of Ethics and Business Conduct. So that's on attachment 1, and then the prior one was on attachment 2. And the reason I wanted to bring that today to you all is I've been mentioning it, but you haven't been able to see the final product. So I wanted you to have that opportunity to see the final product. In May is when we published it, and then we informed the organization of the revision. And then just this month, we began a promotional program where we're taking sections of that code each week and highlighting that through our central, which is our intranet for the organization. And those sections will be highlighted every week through the rest of the year. So that's a good way to get them to digest it, because I know it's a big document, but it allows that to focus on different components of it. And then if there's any other questions, I can talk about more about our plan activities, but that's just really what I wanted to highlight.
Thank you very much, Cheryl. I just had a couple questions. And
Sure.
that is, first of all, the new code of conduct, code of ethics looks fantastic. Really much easier to follow and read, and just want to compliment the team on achieving that. But has the content changed much from the original code?
There is additional content to keep up with current risks, such as diversity and equity and inclusion, information security. So, and then there was just some reorganization of it, and then maybe just some simplifying of the language to the tone. So it's more about we versus you.
Good. And then could you explain the regulatory tracking subscription onboarding? Who's involved in the process, and how has it changed current practices?
Yes, so we have a subscription to that regulatory tracking system to identify, and we can self-serve ourselves. So like as an enterprise compliance, we subscribe to whatever topics we think are relevant to our pension system, so we can get alerts when there's new laws or changing laws that are over not just California, it's throughout the United States. And there's some that are extended beyond that, but it's mainly the United States. And then we worked with various branches and areas such as investment compliance, information technology, information security, and we onboarded them onto the product so they can do their own, when we get those targeted areas that they're interested in, so that it's not just all on one person. So we're continually to onboard different areas so that they can have access to this tool. This tool is accessible by everyone in the organization, but we're taking the time to onboard them. And then it's a newer system, so there are bugs. So when we find little instances, hey, I didn't see this, let's say a bill on there, why not? And then we can reach out directly with the subscription and find out what happened. Do they have something on their side, or is it the way we're searching?
Good, thank you. Questions or comments on this item, members? Oh, I'm sorry, Dr. Yatman, please.
No, I'll go last.
Go ahead. Let me just see. Great, Dr. Yatman on this.
Thank you, Madam Chair. So Cheryl, what's next? What are the next steps? So we've published this, it's been pushed out to the organization. What happens going forward?
With the code?
Yeah.
Okay, thank you. So as I said, we're promoting this to start with doing it in sections every week for the organization. And then next year around March, we do an attestation. So everyone will have a chance to read it in full, like we'll have to certify they read it. But there's opportunities. We wanted to start this way. And then next year we'll be more creative, and we'll probably do opportunities to look and see if it needs to be refreshed. It won't be as lengthy because I think it'll be more refreshed versus revised. And then we'll also do maybe gamify it a little bit in order to get people engaged with it a little bit. And so that's my plan, was my plan. I'm sure I'll communicate that to the new director.
Thank you. Seeing no other comments, let me just, and I was remiss in the prior item, see if there are any members of the public who wish to speak on this item.
There are no members of the public in queue at this time.
Great, thank you. All right, thank you. Then we will take that report as submitted. Thank you, Cheryl, very much. Item number 5, also an informational item, and this is the mid-year progress report on our 2022 internal audit. We have a team here. So Cheryl, if you'll introduce the item, and then I know that Chris is new to the team, so Chris introduce himself, and then, of course, Roseanne.
So item 5 is our mid-year audit plan progress report, and the team's going to discuss each of those areas, but I wanted to first introduce and welcome Chris Wall, who's our new senior leader over employer audits. So he's, for those of you who have been here on the committee for a while, he replaces Mike Dutel, who used to hold this position. And then Chris, I just want to give a brief background, but Chris came over from the other system, he was there for 16 years doing employer audits and also leading employer audits. And so he's been with CalSTRS for less than 3 months. I've worked with Chris before, so I'm confident that under his leadership, the program will continue to thrive. So I'm going to hand it over to Chris to give a little bit more of his background, and also he's going to update us on the employer audit activities.
Hi, thank you for having us today. My name is Chris Wall, and I'll start by giving you a little background of myself. During my time at the other system, I audited public agencies, state agencies, and classified school employees working for school districts. But I am looking forward to looking now at the certificated employees. That's a little bit new to me, but I'm excited to get to know more about that program, as well as the laws here at CalSTRS, which I'm in the process of learning. I have a bachelor's degree in political science and a master's of business administration. And during my career, I've held at CalPERS, I held most positions within CalPERS. I started as a program auditor in entry level at CalPERS, and then I worked my way up to the senior management or senior auditor, which I held for about 7 years. One of the things I value most as a leader is working with all levels within the organization, such as the executive team, legal team, program areas, and external stakeholders. And I'm looking forward to continuing that here at CalSTRS as well. Since I've been at CalSTRS now for all of 3 months, I've tried to hit the ground running. And when I got here, we had quite a few vacancies on the employer audits team. And we've now interviewed for all of our vacancies, and we're in the process of filling those positions, and we should have them filled over the next couple of months. We are currently working also on streamlining our audit process and looking for areas where we can improve to make sure that we do complete the 120 audits in the audit plan this year and going forward. And one of the other things I'm working on is I do have several initiatives that we're trying to work on in the employer audits team. The first piece is the expanded use of our current audit software. When I got here, I found that we're only using small portions of the audit software, and it has a much larger functionality when you use all of the functionality that's built into the system. So I'm working on incorporating all of that functionality. And by doing that, it gives us a greater access to our progress in the completed audits to ensure we complete our audit plan, and it also gives us increased efficiencies. The second initiative that I'm working on is how do we look at the data that we have available to us. We've been working on special compensation audits where we look at, where we try to use the current payroll system to select focused audits, but there's limitations in that payroll system. So I'm really looking forward to, as we transition to Benefit Connect, having access to do more data analytics than we currently have. But we are looking at other ways to kind of be innovative and slice and dice the data to come up with alternative ways of looking at it and selecting effective samples of employers to audit. And I'll kind of get into more of that at the next meeting when we look at our risk assessment. The next thing I want to do is I kind of want to go over where we are at in our current audit plan. And for a full list of all of the audits we've completed and the findings associated with it, you can look at the item 5 attachment 1. But I'm just going to kind of go over some of the highlights right now. And as of May 12th, 2022 is when the data on the attachment is through. We've currently completed 48 of the 120 employer audits that are on the plan. This includes 5 full scope audits and 43 limited scope audits. And then we continue to make great progress in the going forward in the audit plan. And as of June 30th, 2022, we've completed 61 final reports and 21 draft reports. And we're already over halfway to completing the 120 audits in the audit plan. So I do fully anticipate reaching our goals this year. For the 5 full scope audits, we found a total of 16 findings, which include misreported compensation, special compensation, post-retirement earnings, and unused sick leave. For the 43 limited scope audits, we identified a total of 100 findings, which were in the areas of special compensation, unused sick leave, and post-retirement earnings. Overall, we found a total of 116 findings, and 33 of the 48 employers that we audited, or 69%, had at least one systemic finding that was identified. 10 employer audits employer audits that we completed actually had no findings, which is actually slightly up from last year. One of those was a full scope audit, and 9 of the audits were actually limited scope, and they were all based on special compensation. At this time, we can't really use data analytics to pick a more focused sample because of the limitations, but that's where we're at with the audit so far. One thing I do want to point out is the increase in no finding audits between last year and this year is a sign that our audits have been effective. This is especially true if the county offices of education are taking what they learned from the audits of employers in their school district and applying it to other employers that weren't part of the audit. The final thing I want to go over a little bit is their travel policy in employer audits. The COVID-19 pandemic has changed the way we do audits. We've gone from doing all full scope audits to limited scope audits. And a big part of the reason why that was done is so that because travel wasn't a possibility during the initial parts of COVID-19. But however, as things begin to normalize and we begin opening up, we do anticipate that we want to resume traveling for both limited scope audits and full scope audits. We believe that this will increase our overall efficiency, and conducting on-site fieldwork also provides additional benefits to CalSTRS by improving efficiency, making for a better working relationship with the schools, and it also gives us better access to member records. And this concludes my presentation for today.
Thank you very much, Chris, for the presentation. Let me continue.
Yep, so I was just going to say that I really appreciate Chris's willingness to just jump in.
Yeah.
And if you've already heard, he already has some initiatives going. And then that he's actually bringing a fresh set of eyes to the program. So I have every confidence, like I said earlier, but that he's going to just continue to advance our program because he's already talking about slicing and dicing the data in a different way. So next we have Roseanne Oyoung, who's going to present on the update on internal audit activities.
Maybe before we move on.
You want to ask questions now and then go to Roseanne?
Let me just,
Sure.
let me do that. Questions or comments from the committee members? Yes, Ms. Miller. I'm sorry, I have Denise in the queue. Let me take Denise next, then Gail right after.
Shut up, Gail. I'm just all right.
Sorry, I was just.
Hi, Chris, welcome. I just have a question about special compensation. I'm assuming that means off-salary one-time payments, and what else would be included in that category?
So I am not totally sure of this system is what would qualify as special compensation.
Okay.
So I would have to.
Sorry, maybe I directed it to the wrong person. I'm just curious.
Earl or Dr. Yadin, yeah.
We'll get there.
Yeah.
Yeah, I'm not sure I know because I haven't learned CalSTRS. I know CalPERS as well. But I would think that, like you said, like the stipends you mentioned, isn't there other one-time payments?
I mean, like coaching, would that fall into special?
Coaching would be extra duty pay, which should actually be reported as regular earnings.
So I guess that's kind of what I was trying to find the defining line between.
Yeah, Denise.
Jeff is here to help us.
Longevity, okay, thank you.
I'll jump in at a very high
Thank
level.
you.
So there's salary and remuneration in addition to salary. So
Right.
those things paid outside of salary. It could be a master stipend. It could be what you suggested, a one-time off schedule.
So it is
salary.
all inclusive.
Yeah, it's a large category of things. And
Okay.
And those are the things that are often difficult for employers because they don't happen all of the time. Some of them happen fairly regularly. Others are one time, they have a surplus of funds, or for learning loss over COVID, we saw a lot of stipends because of that. They had additional funding. And so we saw more there, and that was a spike in some of those types of cases. They can be complicated because they're kind of different. So that's why they often have errors associated with them. But sometimes it's fine if it's more regular. It's the weird stuff that causes the problems. Abnormal, I should say, not
So
weird.
I guess that's what I was trying to clarify, if special compensation is, quote, the weird stuff, or if that includes the one-time coaching and stuff. So it is two separate.
Yes, yes, yeah. And
Thank you.
and let me retract weird and
I'm
just
just
say
teasing you.
infrequent or abnormal.
And there's a lot more types of pays that do go into special compensation. And that's one of the reasons data analytics kind of doesn't always work with the current system, is all of those type of pays are grouped in together. So we can't separate them out at this point and figure out what pay it was specifically, which would Benefit Connect. We're hoping that's a possibility.
Great, thank you.
Great, thank you, Denise. Gail?
Thank you. I heard I had a problem with my mic. Hopefully it's working now. Jonathan? Okay, great, thank you. I actually had the same question, but I do wonder if maybe we could get a remuneration because it does seem like it seems to be creating some inconsistencies as far as I can tell in the employer reports, the different types of pay. Am I misreading that though? It stands out a little bit just in reading the materials. It doesn't have to be today, but I don't know for the next meeting if we understood all the types, and then it may help understanding some of the information in the report from the employer audit reports.
Gail, are you referencing a specific citation?
Well, I'm just looking at the attachment A, Chris, and congratulations to both of you that you referred to. I just don't see the types of salary listed, and if that is what is creating some of the issues and how you're resolving them. It seems like some of this has to do with the additional remuneration, but again, this can wait until next time. It doesn't have to be for today. I'm just wondering, I had the same question as Ms. Bradford, just because of the way it's represented. Do you know? Okay.
Yeah.
Maybe if it's okay with you, Madam Chair, we can regroup after. Okay. And then maybe if it's okay with you, Madam Chair, we'll, through the chair, send a request of how to remunerate it.
That's
Okay,
fine.
thank you.
Okay. Good, thank you. Dr. Yetman, comments on this?
Welcome to CalSTRS. It's really great to have you here. It's really great to see that more talent has seen the light and joined us. So we appreciate that. I hope what you find is that the organization, I've worked with this board a long time, and I can tell you they're very supportive of the employer audit process and the value that employer audits bring. You get visibility to the board, which is really pretty cool. But moreover, the attitude has been from the board over a period of time, I just thought I should share with you, is audits are vital and audits are important, and audits are audits. We dig in there to find things wrong. I'm an auditor too. But at the end of the day, what you do with that data is you can use it as a cudgel to sort of, beat the employers up over the head and say, look what I found, you did something wrong. Or you can say, hey, here's an opportunity for us both to learn. An opportunity for me to become a better auditor. By look at the findings I'm finding, I can fine tune my audits. And an opportunity for the employers to say, gosh, we didn't know we were doing that right. And we made a mistake. And thank you for giving us the opportunity to fix it. And so that, like you heard earlier, we take these and they go back and they become a valuable part of the organization's internal control process. And so it's an attitude of saying, we're all trying to do the right thing. What can we do to work together to get the right thing done? So it's a neat position. I hope you love it and and never leave. So thank you. I do have just one quick question, which is you're right. I guess two. One is, it's a pleasure to see as an auditor more no finding audits, but at the same time that right, that spikes. It's like, okay, why aren't we finding more? And so, hey, maybe we use the full scope audits to help us identify with the limited scope audits what to look at, right? Well, maybe it's time now to say, hey, they're getting it. They know that these things were our hot button issues and they got them fixed. That's cool. Now we can move on to another set of things and start pounding away on those and saying, now we can take that next step. So it's great there's no finding audits, but I'm sure there's findings elsewhere that maybe the full scope audits can help us uncover. That's all. And I'd be happy to work with you, and I'm always available to you to pick up a phone. I have to let the board know that you've talked, but if they say it's okay, I'm happy to
That sounds
to work with you on that at all. The audit software, so the audit team you have is an amazing team. They work their tails off. They get so many, I'm sure you've seen, they get a lot of audits done for not a lot of people.
They do.
They really do. So they're busy. And so finding time to put education into their busy schedule will be an important part for you to balance. And especially if you're going to try to have them use parts of the audit software that they're not used to using. Right, that you're going to have to obviously acquaint yourself with it, and then bring them in a cooperative way that still finds a way to balance that the workload against it. So I think that'll be a challenge, but I think it's really neat. I loved what you said. So welcome and thank you.
Thank you.
Thank you, Dr. Yetman. All right, let's see. Why don't we proceed? Sure.
So Roseanne?
Thank you, Cheryl. Good afternoon, Controller Yee and members of the ARM Committee. For this reporting period, can you hear me now? Better?
A little closer.
Hello? All right. For this reporting period, internal audits completed the audit of death and survivor benefits. As requested by Controller Yee, we prioritized this audit to get completed. So understanding the importance of ensuring the benefits are provided to the beneficiaries, we performed a thorough review around the controls. Overall, we felt that there were good controls in place, such as a separation of duties between staff who process the benefit payments and those who review and release the benefit payments. There's also a monthly monitoring of address changes and overrides to identify any unauthorized changes. There were also some opportunities to improve controls, and I'd like to highlight a couple of those. First, after contacting beneficiaries and not receiving a response or information to proceed with processing the benefit, the case is placed in a suspended account status. Once moved to the suspended status, there is a need to actively monitor and manage those accounts. Another opportunity is to improve quality control over board reporting. While there was no significant error, there was an error that could have been caught with the quality review. Management has worked swiftly and implemented the quality review and is working to update the procedures. I'd also like to point out that for all sampled cases, members were appropriately paid and supporting documentation was complete. Next, the internal audits also completed the audit of mail-in receiving. Excuse me. This is a process that is frequently overlooked. However, it plays a critical role in the entry and exit of goods and the safety of the organization. We're in a new work environment, and this was an opportune time to perform this evaluation. We identified critical areas to enhance the security of goods, checks, and confidential information. Management has been responsive and worked quickly to secure the equipment, as well as improve processes and enhance procedures. The full summaries are located in attachment 2, pages 2 through 9. During this reporting period, internal audits also validated the completion of management actions. As of May 2022, management resolved 12 out of 28, or about 40% of the findings. We added 20 findings from the audits completed at the end of the prior year. And a detailed list of findings can be found in attachment 2, pages 10 through 14, which indicates those that have been resolved and those that management is currently working on towards resolution. I'd like to also add that management has since resolved the PBI findings, which are over 1 year old and rated the highest significance of the highest significance rating. And that could be found on attachment 2, page 11. This will be included in the next reporting period. Internal audits work in progress includes 5 internal audits listed on agenda item 5, page 3. They are transfer employee system access, travel management, path forward, strategic and business planning, benefit payment modification. We are also currently facilitating 2 audits performed by external audit firms, an investment audit of investment services and investment accounting performed by Grant Thornton, and a technology audit of application incident management performed by Weaver. Our next steps will be to conclude the audits that are currently in progress and start our annual risk assessment, which will be used to generate the 2023 proposed audit plan. We will report on our results at our next committee meeting. Thank you, and I'm happy to answer any questions you may have.
Thank you very much, Roseanne, for the report, and very appreciative of the prioritization of the death and survivor benefits audit, and very happy to hear that all payments are appropriately made. So, but always room for improvement. So happy to hear those recommendations. And then could you expound a little bit more on the mail and receiving audit? As you mentioned, an area that sometimes is overlooked, but quite a few findings there. And I just wanted to just have you maybe give some flavor to that and the kind of work that's in progress to address some of those.
Sure. So according to our records, the area of mail and receiving has not been audited ever. So that's part of the reason why you do see so many. So this is like the first time, right? And it probably is an area that typically doesn't rise to the level of the highest risk, because as you know, we do a risk assessment, and it doesn't typically rise to that level. But considering all the transition that we've been going through and the pandemic, and many of us were not on site, and now we're in a hybrid environment, we thought it would be a good opportunity to take a look to see how we are doing. So there were probably one of the most significant findings had to do with an influx in the ordering of IT equipment, because now, as you know, we are set up to work both here on site as well as remotely. So there was a huge purchase of IT equipment, but yet I think the area was not prepared to necessarily receive such a large shipment. The equipment we identified was not in a secured location. So, but they have since resolved that. There is now an area that has been designated. It is secured, and they actually have been really working very swiftly to address many of these findings. And a few of the other areas were the checks. So checks come in through receiving, right? And as you probably know, there's an opportunity there, right? Because these are checks. So we didn't see that there was a dual two people, and this could have also been because of the pandemic and reduced staffing. Two people counting how many are received, right? As well as there is also a transfer of custody. So they do deliver them. They secure them, I think, in a safe, but that safe in itself, they did not change the combination frequently. And as you know, sometimes there's a change in staffing, and then so people who have left would still have access to that, if there was a bad actor or what have you. And then there is a transfer in custody where then eventually it is delivered to accounting. So just, kind of keeping track of who is in possession of the checks, I think is important, as well as, and then the confidential mail, I think there was an opportunity to update that listing of the confidential mail to make sure that there, again, transfer of custody, or making sure that when we do deliver it, that it has been delivered to the rightful location.
And those higher risk findings that she mentioned just now, she's been working and talking to facilities, and they have made that a priority in resolution. So even if the date may be extended out on like one or two, I'm like, is it really next year? But no, they've already completed it. They made those higher risk ones a priority.
Thank you, Cheryl. Dr. Yetman on this item.
How did you guess, Madam Chair? So Roseanne, welcome. Did you say this already, that she's?
Official.
Yeah.
But yeah, she's been here before, but I guess.
Yeah, okay.
This is the first time I'm presenting in this room, so it's an honor to be able to see all of you in person.
So Roseanne has taken over for the chief auditor who had that position previously. So we have 3 brand new people in their brand new positions. Senna, my question, a couple questions. What's the timeline on the grant, on the investment audit, the Grant Thornton investment audit?
The timeline?
Yeah, the timeline on that, is that?
Oh, that would be last year. You mean the scope period?
Yeah, when are they going, when's it done?
We plan to be able to report on it next at the November ARM Committee meeting.
Oh,
So it's currently underway.
oh, got it. Okay, good, good. Yeah, so we're going to see it in November. Yes. Yeah, that's a tight one. Yeah. And then, with, my standard question is, up until this point, with the internal audits that you've done, are you happy with management's response?
Oh, absolutely. Actually, I'd say within the last few years, we've seen management be more responsive to and make it a priority to close or address findings, particularly those that are rated at the highest level.
Thank you.
Can I make a quick comment on that? I think one of the areas that I think is important with management's response is we changed an approach about a year or two ago on when audits goes in there and we do find some issues, we don't just make a recommendation and wait for their response. We collaborate with them because we are the risk and control experts. Well, yeah, and I was thinking, am I in compliance or audits? We're in the risk and control experts, and they're the business area experts, right? So we made that more of a collaborative effort to create a solution and an action item that will work for us and them. And so then that allows them to be more responsive and to resolve findings quicker.
Thank you. Questions or comments, members, on this item? Okay, seeing none, let me see if there are any members of the public who wish to address us on this item, item number 5. Okay, seeing none.
There are no.
Oh, I'm sorry. Anyone on the phone line? Seeing or hearing none, we will take this report under submission as submitted. Thank you. Thank you so much for the report. We'll move on to item number 6, which is review of information requests. Trevor, I don't believe we...
There was an information request for item 5
Yes.
on the discussion of specific types of compensation.
Right, and I think that's going to be fleshed out a little bit more, so we will follow up with the staff offline on that. Thank you. Moving on to item number 7, this is the draft agenda for the next committee meeting. Members, November Audit and Risk Management Committee is our heavy meeting agenda, where we are going to be receiving the audits currently in progress. So you will see in item 7 the draft agenda with several agenda items that will be presented by our independent financial auditor, as well as looking at the various areas, including our basic financial statements and our other pension information items as well. And Dr. Yutman, anything of note to, or Cheryl and Dr. Yutman, highlights?
Thank you, Madam Chair. So the first thing jumps out, yeah, this is a big meeting. This is where a lot of what goes on in the year happens. So the internal audit plan report that Roseanne just talked about is consent. I wouldn't be surprised if a board member wanted to pull that off. And so being on consent, there isn't any time allocated, of course, but I wouldn't be surprised at all if that came off consent, depending on the findings, right? We just don't know. So and then when I turn the page, I see the item number 6 is the management letter. So that's the management letter that we talked about just earlier. We started with last year's management letter, right? And we're still working through. We don't know what that's going to say. It may be really short. It may be probably not very long, but we don't know yet. And so there's 10 minutes allocated. That may take a little longer. We just don't know. So I just don't want the board to feel rushed. But I know that, of course, time is a really valuable commodity at these meetings, and there's so many important things to look at and do. I get that. I work with the board on this committee, so obviously I'm going to say, hey, let's give it its due. But I would raise visibility to the possibility that the management letter might take more than 10, and that someone might pull something off consent.
We can work with our chief auditor to rebalance
Sure.
the scheduling of it to make sure that we accommodate all the time needed.
Okay, yeah. Yeah, I think when we put these agendas together, we just don't have enough information, so we will adjust accordingly as we learn what is forthcoming before this committee. Very well, thank you. Cheryl, anything else, Seth?
I have nothing else, but I appreciate the opportunity.
Thank you. You're welcome. Congratulations. All right, let me see if there, Brian, yes.
the meeting. The membership of the committee right now consists of the controller, the treasurer, the superintendent of public instruction, the director of Department of Finance, and Ms. Bradford.
Okay.
Although we will reflect everyone's attendance right now,
Yes.
that's the official committee roster.
Thank you. Thank you, Brian, for confirming that. Perfect, thank you. All right, let's now turn to item number 8. This is opportunity for statements from the public. Let me just see if there are any members of the public who wish to address the committee.
There are no members of the public in queue.
Thank you very much. So seeing and hearing no other business coming before the committee, this meeting is adjourned. Thank you. Thank you, everyone. And board governance, Jennifer, what time? Started, 2:25?
Welcome to the Board Governance Committee, and we'll be going through the agenda that we have. Much of our work for this fiscal year is a continuation of the conversations around continuing to look at learnings from the pandemic and where we can incorporate that in the spirit of continuous improvement for effectiveness, productivity, and maintaining very excellent best practices and transparency. And we really encourage, and we'll take roll in 1 second, but really important to ensure that all voices are heard and thought is brought forward. We want this to be a conversation as we've started. So Katie, if you could take the roll, please.
Ms. Yamamoto? Here. Ms. Bradford?
Here.
Mr. Tang?
Here.
For the Superintendent of Public Instruction, Mr. Johnson? For the State Treasurer, Mr. Ruffino?
Present.
For the Director of Finance, Ms. Miller? Chairperson Erden, you have a quorum.
Thank you.
I will now go ahead and read a statement.
I'm going to, for the purposes of this meeting, the chair has added as ad hoc committee members, the state controller and Mr. Gunny. And I reflect both of them as present.
The CalSTRS board meetings are live web streamed and video archived and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item that the speaker wishes to address. For comments not pertaining to a specific agenda item, there will be an opportunity for additional statements at the end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there is not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of callers under the age of 18 who wish to address the board, their first name, affiliation, organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. Thank you.
Terrific. Thank you. So action item number 1 is action item. It's approval of our agenda. Any opposed? Any abstentions? So moved. Great, thank you. And then our second is consent, and it is sorry, my eyes are super blurry, so I have to apologize if I'm being clunky. But the approval of the minutes from our last meeting, the May meeting. Is there a second? Any opposed? Any abstention? Great. Now the third, it's a consent item, but it's a meaty information item. And this is to continue our discussion in the follow-up on the board materials and the write-up template. And we have seen work being done to date, which has continued to streamline the materials. It has sought to achieve a number of objectives. That conversation is continuing, and through that has been a balance of the recommendations, the rationale, the substance, and the education. So this is really in the spirit of continuing to collect input. Amy, together with the executive staff and deeper, I think, in the organization, have done a tremendous amount of work on this. I might also mention Sharon is not here, but has been very involved as well. And we had a prep call for the entire agenda together with Amy before this meeting. So I might turn it over to Amy then, and then as we get to discussion, please bring forward all conversation. And it will continue to be continuous improvement. If we make changes and we don't like what we see, we are adaptable, we are flexible, and we're committed to effectiveness and transparency. Amy.
Thank you, Madam Chair, members of the committee. Good afternoon. I'm Amy McDuffie with Mosaic Governance Advisors, the committee's consultant. It's a pleasure to be here this afternoon. And just so I am on the right item, my sense, I think I heard that you talked about item 3, but now we are on item 4. Is that
I'm sorry, I
correct?
thought that was going to be, and then that must have been my eye, so I apologize. May I? The board materials, item 3. What mine says.
Sure. Yeah. So item 3 was just a consent information item containing a follow-up on.
I'm sorry. On the yes.
Yeah, the board
on
meeting
the,
materials.
Right, go
Correct.
ahead. Yeah. May I just actually retract? Why don't we do? Can we move and do item 4, and I'll come back to item 3. Thank you. Sorry about that. I'm being clunky too. It must be the word of the day. Sorry. Apologies.
Sure. So moving on then, per your request to item 4, Madam Chair, which is also an information item. And I wanted to also echo the comments you made earlier about seeking feedback from the committee, because that's in essence what we're looking to do at this point. This is part of an ongoing conversation that we've had. The board has been interested in integrating lessons learned from the pandemic over the last year. You might recall that this whole conversation started as an outgrowth of the board self-evaluation in October of 2021. Also, in connection with the organization's new strategic plan, the board has a theme of innovation that's riding within the strategic plan. And innovation, of course, requires making a purposeful decision to revisit your longstanding assumptions within the context of changing conditions, to take a pulse on whether or not what your norms are currently are still fit for purpose, and whether there's any adjustments that are warranted. So all of this is happening at an opportune time, and it is opportune. This is not a review that has been conducted because something has been found to be incorrect or not working. So I also wanted to stress that as well, that this is really taking an opportunity to step back and identify where there could be improvements in alignment with maintaining your culture of excellence and governance, which continues to be important to the board, to the committee, and also the high degree and level of transparency, effectiveness, and efficiency that this board and its stakeholders have always enjoyed. So that's the underpinning for all of the activities that have been conducted over the last year. In the write-up that we provided to you, and I wanted to thank Cassandra and the entire executive staff just for the participation and collaboration from their side in coming up with meaningful options. We really took a lot of time to think through what the board's plate looks like right now. And with the new priorities that have been set out by the strategic plan, how to make sure you're spending the right time talking about the right things. I think it was Dr. Yetman just in your last committee meeting that said that board time is precious, committee time is precious, and indeed it is. So again, it's incumbent upon us to stay vigilant as priorities are shifting and changing, as conditions are shifting and changing. How do we optimize what your agendas look like? And through, of course, that process, as you all know from the May meeting when we talked, there seemed to be a bit of an imbalance. You had meetings during fall of each year, which seemed to be clustered or bunched around 4-week intervals. And then you had other meetings which seemed to have a very expansive time period, 12 weeks between them. From a governance standpoint, we want to make sure that there's a consistent information flow so the board can stay in the stream of information operating at the level that this board operates at, which is a partner, a sounding board to your management staff as you oversee strategy, risk, performance, and people. So that's the backdrop that we looked at this through. I wanted to walk through, there are two options that we brought forward to you today. And they ride along the same line, which at the high level was to look at how to change the format of your offsite. And option A, and this is in the write-up for option 4, it's page 2. It eliminates your September regular meeting and redistributes that workload across other regular meetings, but it also carries some of the time-sensitive topics from your September meeting into a now September offsite. And again, both of these are concepts only. So there's no planned fiscal year that these are attached to. Please consider this a prototype. But option A, again, is to move the October offsite to September. You'd maintain some regular business items, probably 2 to 3 hours as part of that. And you can see those listed on page 2 of the write-up. It would be sharing the operating budget concepts with the board, which is a requirement, just within the norm of how this board likes to receive information. Receiving a semi-annual enterprise risk management report. And in talking with Julie Underwood and her risk team, the idea there would be that you'd receive a kind of a consent item of your normal risk management report with the ability then to flex into topics like existential risk and emerging risks and have a deeper dive at the offsite. So that was the concept there. And then of course you have your time-sensitive semi-annual investment performance reports as well. So think of that regular business for option A in addition to some of the routine governance items that the board always tackles at your offsite, and those would be the CEO evaluation, the CIO evaluation, your board self-evaluation. So outside of those two buckets, then you'd have time to allocate towards your priority items of interest. That can be education, it can be interactive discussion, it can be a speaker, for example. That's what option A looks like. Attachment 2 provides a work plan. So you could actually see over the course of a year how the work was redistributed to fit that type of option. Option B, and I'll go through that quickly, and then Madam Chair, I'll turn it back to you to facilitate the feedback on both of these. Option B took a different twist. And again, there's a sample work plan that's included in attachment 4, but the concept here was to reconsider the offsite as we have all come to know and take those routine governance items, the CEO evaluation and the CIO evaluation, and uncouple them from the offsite. And again, I always like to think about the offsite. It's usually a 2-day sequence. It would continue to be a 2-day sequence, but think of it like a mall. The CEO and CIO evaluations are your anchor stores, right? They're always on the offsite agenda. And we started to, when we sat down and thought about this, we asked, well, why? Why is that? Why couldn't they be part of your September regular meeting, for example? And so that's how we started to build off of that concept. By uncoupling the CEO and CIO items and moving them, as you see in the work plan, to the September regular meeting, it really frees up your space as a board to start to focus more on your priorities that the board wants to stay abreast of. So it really cleans the slate and provides you with an opportunity to truly customize both of the days instead of having such a heavy allocation in your offsites to the routine governance evaluations. So both of these options, again, we looked at the board's operative principles. We looked at the objectives as we've outlined in the item write-up to try to ensure that we were best meeting the needs as expressed so far. And today, again, the idea is to get your sense for what could work well from these options. What might you want to see differently? And one other thing I would say on option B that I wanted to underscore, it was in the write-up. We selected the July meeting in the calendar, which is attachment 3. And the idea is that if there were no specific calendar dates, it shows 3 days, but really it's a 2-day meeting. So I wanted to point that out. If it needs to shift to the end of the month, if it needs to be a different month of the year, we just wanted to show flexibility in being able to schedule the offsite in a way that could work for everyone. And again, taking out the time sensitivities. So I know that was a lot that I just went through. Madam Chair, I'll turn it back to you, but really interested to hear what the feedback is today. And again, it's an information item.
Perfect. And then we're waiting for speakers. I thought in doing it as a guide, and please don't take this as a rule, but one way might be to say in concept, which organization A or B do you like? And secondly, do you see any schedule constraints around it, which would be worked out, or other concerns? So just to separate the idea of the concept of how it's organized from exactly when it falls, and then make a comment about when it falls, if you like the concept, but you have a concern about where it falls. We have Lynn.
Thank you, Madam Chair. And I just want to say that we appreciate all the work that the staff has done and that you have done as a chair, and along with you, Amy. And, I think that it actually does, it smooths out the meeting schedule a lot better now, so we don't have those big time gaps in between. And also in recognition of the fact that Controller Yee will be cycling off the board in January, so this schedule won't impact her or our office. But we did want to raise the issue that it just seems that losing another meeting will make the schedule even more compressed. And over the past 8 years, we've seen a lot of different types of schedules that the board has adopted. Once upon a time, there were more meetings, more offsites, 3-day cycle meetings, and not sort of 2. Just don't want to lose sight of the transparency, and also the fact that with the newer board members, it is important to make sure that they have the benefit of understanding all the items that are coming to the board. So I'll be abstaining on this vote today on this items, but we did want to express the concern that we don't want to see it so compressed that the work is no longer done I don't want to say it that way, that the items are not given enough understanding and presentation time to go through, and also that the public doesn't lose opportunities to see all the good work that's going on here at CalSTRS.
Denise.
Lynn said a lot of what I wanted to say. I wanted to say thank you for the work, and I do appreciate the meetings being spread out, but we did used to have a 3-day cycle, and now going down to 2 for every single meeting and losing, I'm a little concerned about. The other thing is I'm not knowledgeable enough to speak to it, so I just want to ask the question. I've spent a lot of my time on the board at home, and I'm just now learning kind of the conference circuit and things that we attend. And I noticed there's some conferences on the schedule, but I think that there's a lot more that board members attend. And so I'm just not sure how that impacts the schedule. And I haven't had time to really map it out. I don't know if somebody has a comprehensive list. For example, in July is usually a week at Berkeley. I can't even remember the conference, Karen, but we really, NCTR, and I know that a lot of us really like that, so I think we need to be mindful of that one. And another one that just comes to mind is Trustee Leadership Forum, and normally that's in June, but since COVID, now we're doing it in July, so I don't know if the general schedule is changing, or if things are going to kind of go back on schedule how they were, but I think we need to be mindful of all the kind of the extra things that we do.
Gail.
Thank you. I also want to acknowledge the work and really appreciate it. I'm sorry, Ms. McDuffie, I'm having a hard time really understanding the difference. So I first have a basic question. So the option 1, the option A, is the meetings. I actually do, I do like the schedule, but I would like certain metrics to be met in terms of transparency and making sure that the work isn't compressed, which I think is is something we can do when we add, if the board were amenable to this, it's something we could do when we get the board results that you do, the survey results, to make sure, and we could do sort of quarterly check-ins to make sure the meetings work. The reason I am a big advocate of fewer meetings is because I am always concerned that staff is spending a lot of time preparing for board meetings rather than doing the work. So finding that balance, I do think is a really important one, because I think we as a board, every time we meet, and I am probably the most guilty of everyone, but we have new information requests, and then we actually increase the workload, which I sometimes think if we could be a little bit more focused, it would help us in terms of just our team being able to manage all their time. And there wouldn't be new issues, for example, that come up at investments. And so I do think there's a trade-off, and I think it's worthwhile at least trying it in terms of giving our team the opportunity to work. But I think where I got a little bit confused, I think what I'm understanding is that in the option B, the offsite is in July in this tentative calendar, and then in option A, the offsite is in September. Is that correct? So the offsite is more of a working offsite, which I do think is a better use of the boards. In either scenario, is it a working offsite where we'd have some actual board work at the offsite?
So, Madam Chair, Ms. Miller, let me respond to that question specifically. So option A has a September offsite that includes some regular business. And again, the work plan that we mocked up redistributes the work from the September regular meeting to other regular meetings throughout the year, because you do have some months. July is one of them. January is another one where the board agendas are lighter. And so we tried to take items from the September meeting, regular meeting, and redistribute those so that you can continue to do the good work and decision-making and have the effectiveness and efficiency you're looking for. It was just that there were some time-sensitive items for September that just we didn't think would be prudent to wait. And so those are the ones that came into the option A offsite format, along with your routine governance evaluations of your CEO and your CIO. So that's kind of snapshot A. Option B does not include any regular business, and it also does not include the CEO and CIO evaluations. So option B is really set up to frame up an offsite that is directed by the topics and priorities that the board has facing it at that time. It is a blank canvas for the board leadership to work with staff and committees to identify what are the topics that are really going to help move the ball forward now. We selected July as the month to could be a different month. It could be later in that year, or I'm sorry, later in the month of July. It could be in January. It could be in any other month. We just started there because we could, quite frankly, after we took out the CEO and CIO evaluation.
So I think if I were to just speak, Madam Chair, I think you were asking about a preference. Again, I don't mind reducing the number of meetings as long as we're very mindful that if it doesn't feel to everyone like we're doing the work we need to do. I do like option A as a prototype for two reasons. One, I do think it's important that the time at the offsites is really well spent. And I think it's okay to do a little bit of business. I think a lot of information sessions sometimes aren't very interactive, and they feel a little overly pedantic to me, just in terms of a lot of people speaking to us rather than maybe collaborating. And I think it's really important for the board. I mean, I'd love to hear your thoughts on best practices, but the evaluations, I think having it at an offsite really provides an opportunity for deeper conversations with our colleagues that I think, really partner with on this work. And I found it to be really rewarding to have a moment away to think about that, because they are entrusted with such large jobs. And it seems to have been, of course, it's how we have done it, so I don't want to fall into that pattern, but it does seem to be kind of a lovely opportunity to reflect. I don't know if CIO or CEO agree with that at all, but it seems to have been a good opportunity. So I have a slight preference for option A, and I'm eager to try what a more efficient board schedule could look like. And then wonder, just to Ms. Paquin and Ms. Bradford, if adding a third day to any of the meeting months would give any comfort in making sure that we're not, especially to your point, Ms. Paquin, about transparency, if that would help at all to negate some of those concerns.
Thank you.
Thank you, Madam Chair.
Thank you, Gail. Karen.
Thank you, Madam Chair, and thank you for the presentation. And a lot of my questions were presented already, and my concerns. And just to kind of review some of the things that I wanted to say was about the number of meetings, that we don't lose sight of all the work that we're doing, the extra and the time in between, so that staff can prepare for the meetings and not be just preparing for the meetings and not doing their work like Gail had mentioned. But I also, with all the offsite, I guess I'm still confused as to the September one for option A. I like option A. I mean, that's my preference right now. But for the offsite meeting, I guess I'm confused as to what you envision or what you're talking about as to what would happen at that offsite.
Yeah. If I may, thank you. Ms. Yamamoto, so if you can think of the offsite for option A as kind of containing 3 buckets of content. The first bucket of content would be your routine governance evaluations, which are the CEO and CIO evaluation. And in prior years, those have typically taken about a half a day. They are very comprehensive conversations. They're interactive. So that's the first bucket. And also your board self-evaluation would be within that. The second bucket would be the regular business items that would come from the September meeting that would be eliminated under the construct of option A, the September regular meeting. And there are 3 types of content that would be included there. You have the proposed operating budget concepts, which your CFO likes to deliver to the board in advance of bringing you that decision unit in November. So that would be one. You have the semi-annual enterprise risk management report from your risk team, which again, as I mentioned earlier, could be used to springboard into a conversation around existential risk, emerging risk, deeper dive conversations. And then the third, which would be time sensitive, would be the semi-annual investment performance reports. So those would be the regular business items under that second bucket that would come on to your offsite, your now September. So option A features a September offsite, still in the fall, just not in October, in September. So those are the first 2 buckets. And then the third bucket would be a blank canvas of addressing the board priorities in a way that makes sense. We know from the survey that we conducted earlier this year that the board likes to make sure that the offsite meetings contain opportunities where you can interact and deliberate with each other. So the focus of those types of content segments would be along those formats, whether it's an external speaker or an opportunity to define new terms in accordance with your strategic plan topics or principles that might need to be sorted out. Those are the types of topics that would be in that third bucket. So governance items, regular business, and blank canvas.
And then
for
would
that
all
offsite.
3 of those buckets be an open session?
Your routine governance items, your CEO and CIO evaluation are typically closed.
So for benefit of our stakeholders to know
right.
what's happening at that particular board meeting, then it would be a closed session and then open?
Yeah, so the second bucket, the second and third buckets would be open session. That's the typical format.
Thank you.
Thank you, Karen. Any other thoughts? Otherwise, I might pose a follow-on, if I may, if anyone has anything to add to it. If we think of option A and option B, it's what I may just summarize a little bit, because it sounds like one is the board continues to be committed to transparency, committed to ensuring that we have adequate time at our meetings to discuss in a fulsome way, as well as the education, the information, and the action items that we have as the board's plate. And we want to, and I think this is what we've always done, continue to ensure that the public, is able to have the benefit of that transparency. And then it sounded to me like part of the difference was, do we have the CEO and CIO at the offsite or in a meeting? And if we need more meeting time, is it having 3-day meetings, or is it having another month that we meet during the calendar? Instead of 6 meetings, go back to 7 meetings. And these are all levers that we can work with, but if there's anything that anyone did not speak on that relates to any of these points, in addition, what level, Oh, Ken came up, sorry, he was blank, excuse me. Terrific. Trying to draw you out. Thank you.
So I guess for me, I guess I was looking at the 2 options, and I guess there's 6 meetings, and they're kind of separated pretty much evenly, and I think that's our purpose of doing that, right? But I guess for the benefit of Michael and myself, because since we're new, did we had just 6 meetings prior to this, or were there more meetings than 6? Because from my understanding that we're supposed to have another offsite meeting in October, and that's like what's being discussed right now, is like cutting one of the offsite. Is that where we're the plan, or is this is kind of like in the discussion? Just so that for the benefit of both Michael and myself, just to realizing like, okay, so that we're basically going from a certain number of meetings to now 6.
Yeah, do you want to take that, Amy, or should I?
Sure,
I'm
thank
happy
you,
to.
Madam Chair. Mr. Tang,
Yeah,
yes.
thank you, it's important clarification.
We did discuss this at the committee meetings in May. There have been in some prior years, instances where you have 2 offsites, one in October or September, and then one in the spring. And that was the case this year, this past fiscal year. Now I guess it's the new fiscal year. I have to remind myself of that. In the recommendation that we made in May at the committee meeting was to put the second offsite in the spring on a cadence, a sequence of every 3 years. Because what the board found to be really valuable was to have the opportunity, once the new 3-year strategic plan was approved, to sit with the executive staff and talk through priorities. What were the things that were going to hold the board's focus for the coming fiscal year? So that exercise was very fruitful. And instead of making ad hoc decisions around spring offsites, our recommendation to the committee, which was approved last time you met, was that we put the second offsite, the spring offsite, on a 3-year cycle. So that's what's contemplated there. Your typical meeting cadence has been 7 meetings a year, 6 regular meetings, 1 offsite. And the clustering that we found as we looked through the balance of your workload was that many of the meetings had 4 to 5 weeks of spacing between them. And just as an anchor concept, the board meeting materials preparation cycle itself is 4 weeks. So we also had an instance in that kind of calendar where you had 12 weeks between your November and your January meeting, which was too expansive. I think all of you felt that, and we felt that too. So information quality, information consistency, keeping the momentum on priorities. So in order to redistribute the workload so you could continue to do the good work that you're doing, we looked at how could we get between 7 and 9 weeks consistently. And so that's why you see in both of these prototypes, whether it's option A or option B, you have 7 to 9 weeks consistently between meetings, typically every other month, with 1 offsite in this construct, but realize that every 3rd year you'd have 2 offsites so that you could then have conversations around strategy and risk relative to the new strategic plan.
Risk of over-clarification that this is all, as Amy said, prototype for discussion, for consideration to try in a future fiscal year. That there's no change with this year.
Right. Thank you.
Are there any other input, comments concerns? Okay, thank you. Thank you very much.
Madam Chair, if I could just make sure that I'm clear on this side, and perhaps the staff is too. The November meeting will be the next opportunity for the committee to discuss this. Would you like us to bring you a follow-up of any kind? Would you like us to focus on option A? It seems like that was the option that was preferred, and maybe put more meat to it around actual dates. Looking at some of the external events that trustees go to, they're showing up on these calendars only because I forgot to delete them, so that's on me, in all truthfulness. But that might be a next step, and I just want to take the temperature to see if that would be in alignment with your thinking as well. Okay. All right. Thank you for the
Okay,
feedback. We
and do
really
you have-
appreciate it.
Ken?
And I guess in following up to what you're saying, Amy, is it possible to add, like, I guess, conferences that are, or things that we're supposed to do as board that are regular in those?
Generally, we do have conferences. Denise is right. They've been slow in getting back on track, and the timing's a little bit, unpredictable at this point, but we'll do our best to see and forecast when those conferences are, because those are important, of course. We all have important other activities that we're all participating in, and we'll work to try to get all of those that we can. We can look from the education items on the things that you guys are attending, as well as what staff is required to attend.
Would it work for purposes of working through this, since we're talking about futures where these conference dates, some are repeating, but others aren't? But if we came forward with a discussion, understanding that it would then be mapped with conference information, and maybe board members, is there a method where it could be cleared with the board members if there were important conferences, so everyone's on the same page on which conflicts we should be quite mindful to avoid in order to ensure full board participation?
Yeah, I think
Okay.
we could do that.
Great. Thank you. Okay, if we could do a go back to agenda item 3, and I'm sorry, that I did not catch that was a consent, so I actually pulled it without pulling it, so thank you. Because we had a wholesome conversation. So in that, on agenda item 3, it's just the consent for the information on the item that we had around the meeting materials and the template. Is there anyone opposed, anybody abstaining, and if not, absent hearing any? Okay, so that's moved then. Thank you, and my apologies earlier. So item number 5, review of information requests. Great, thank you. And then the draft agenda for the next committee meeting, item number 6. Comments? Okay, any opposed? Okay, great. So moved. And item number 7, I don't think we have any members of the public in person. Samantha or anybody? Sorry?
Sorry, there are no members of the public waiting to comment right now.
Terrific. Thank you. So that, I think, adjourns the meeting. Thank you very much. Thank you for all your comments and really the very thoughtful input.
The gavel there.